But the question we wanted to know, is it enough now? Do we just need to take the existing investments to maturity, or is there something that's missing still? What we found out is that there are 6 main constraints that stakeholders seem to see a consensus across in terms of what's still missing. The first 3 are what we would call structural constraints, pieces of a landscape that are still missing. Number 1, there is a systematic economy-wide shortage or constraint in available credits. Demand for finance in Ethiopia massively outstrips supply. And that's not an agriculture problem, that's a national economy challenge. Second, the high costs and risks of financing agriculture mean that as new capital comes into the country, as the banking sector opens up, as new funds come from development partners, international financial institutions, the chances of it flowing to agriculture enough to move a needle is limited, because at the moment the additional resources are swallowed up by other sectors which are lower cost, lower risk to finance. And then thirdly, we talk to banks, SACCOs, MFIs, who've been involved at the front line of trying to finance farmers. What's your experience? And they tell us it takes weeks, months of hard work to finance one single farmer for a very small loan size, given the size of smallholder farmers. I think some of my fellow panelists have been involved in great detail in trying to navigate the constraints with regulatory documentary requirements to fulfill KYC, we heard about that earlier, as well as do credit appraisals. The second set of challenges are what we could call coordination challenges. It's not here that nothing has happened, it's rather that things have happened but not being coordinated sufficiently to drive a national level sustainable scale up. And key areas here include financial literacy, include agricultural risk management, insurance, include linkages between different sectors, between the commercial sector and the rural sector, between domestic and foreign banks in the context of the opening up of a banking sector, and very importantly, as digitalization progresses at pace, between the institutions, the financial institutions, and the new emerging digital platforms. So these were the 6 big constraints where stakeholders said something still needs to be done. So in addressing those constraints, we tried to, first of all, study Ethiopia's experience across the African continent, and further afield to some success stories like India, Brazil, and others. And we came up with 3 pillars which we believe could be suitable in addressing the remaining constraints and integrating and energizing all of those investments that have been made to date and helping drive that scale up. The first pillar is intended to address the credit constraints. So what's needed here is not only to make more credit available, but also to make sure that it reaches agriculture. And not only that it drives agriculture overall, but it also addresses all the different segments where there are underserved populations, underserved regions, underserved value chains, underserved use cases, gender, and others. But at the same time, making more funds available, one needs to also mitigate the risks. We've seen experiences in other countries where minimum lending requirements have been made, where funds have been made available, but if the cost of financing agriculture and the risks are still very high, then it's going to be an artificial bubble that's created that's going to sustain as long as donor funds or support comes in, but will go away as soon as that's taken away. We're looking for something that's sustainable and in line with a transformative and bold agenda that we've heard about this morning. So what we're proposing is a national refinancing and risk-sharing credit guarantee mechanism. The idea is to mobilize centrally the funds that are coming into the sector and create a framework of incentives that will give the private sector the opportunity and the incentive to scale up. The second pillar, we drew on some experiences from Asia, from West Africa, on how to address this challenge that it's so timely, so costly to finance a farmer. How can you streamline that process? How can you take away all the documentation, all of the back office efforts, all of the journeys from the farm to the branch, branch to the farm. We looked at the experience in India of what's called the Kisan credit card, in West Africa, the cocoa and coffee card. But we also realized that credit cards are not the only way of going. What's most important is that there is a unique identifier for a farmer, and behind that identifier sits, on the one hand, all the information required to complete KYC and to perform credit appraisal, so that the bank, by accessing the identifier, can immediately get all the information they need to issue timely to the farmer the loan that the farmer needs. And two, a credit scoring mechanism, so that using alternative sources of data, as well as new data that's becoming available at the Ministry of Agriculture, the banks, the MFIs, the SACCOs, can do credit scoring in a systematic and risk mitigated way. So Pillar 2 is about reducing the cost and streamlining the process of financing the farmer, and complements Pillar 1, making available new funds and reducing the risk of financing the farmer. And they go together to address those structural constraints. Pillar 3 is all about coordination. It's all about trying to synergize, bring together different institutions, working together under a common strategy, a single set of long-term objectives that enable national level scale up. This is in the areas of literacy, it's in the areas of the capacity of the financial institutions and their regulators, it's in the area of agricultural risk management, and it's in the area of linkages. So this is the framework we're presenting. Afterwards, you'll be given access to the document. You'll see there's a lot of detail that sits underneath this. But I was paying attention this morning to what were the key themes that were brought up in this morning's sessions and how they link into this framework. So number one, the framework, it's a partnership, whole of government-based approach, which bridges the financial and the real sectors, bringing together the National Bank, the Ministry of Agriculture, Ministry of Trade, Agricultural Transformation Institute, the National ID Scheme, and others. Number two, it's a digitized, data-driven, incentives-based approach. It's a framework that leverages alternative data and alternative movable collaterals, along with new innovations, the National ID Scheme, the fintechs, AI and big data, and others, as well, very importantly, as an evolving agri-stack at the Ministry of Agriculture, where they're bringing together different areas like digitized extension services, digitized input supply and distribution chains. So bringing all these together into the same framework. And number three, it's a catalytic, time-bound approach. The idea here is to crowd in and scale up private sector. It's not public sector-led, it's private sector-led, aiming to build the capacity and stimulate competition and innovation, which is what I think we heard from this morning Ethiopia needs right now. Thank you very much.
Thank you very much, Adam, for that presentation. I think it lays a good foundation for the discussion that we're going to have this afternoon. Welcome, everybody. You look all very energized after lunch, so I'm glad you could join us. I heard there's a competition for the best panel, so I think we're ready for that competition to begin. So thank you. My name is Hanna Falaka. I'm a consultant with the World Bank, and I'll be moderating this afternoon's session titled Harvesting Growth, Unlocking Agriculture Finance in Ethiopia. And Adam has laid a great foundation with the roadmap that is going to be launched. He mentioned that it'll be shared with everybody as well. I think the last point he made is very critical. It's a catalytic, time-bound approach that's going to be private sector-led. So I think that's absolutely music to our ears for sure. So thank you, Adam. And Adam is joining us on the panel to take questions from the audience. So we're one of the few panels that are going to have questions from the audience. I like to have a very interactive session, so I'm not going to ask a lot of questions. So please, I encourage you all to begin thinking about some questions that we're going to have for our panelists. So with that, let me introduce the panelists. So we have Mr. Abraham Andreas. He's the founder and managing director of Lirsha Agro Green Solutions. We have Mr. Riyad Naur, who's the regional manager for the Financial Institution Group Advisory Services in the Africa region for the International Finance Corporation. And then Dr. Jonathan Agwe, who's a senior technical specialist in inclusive rural financial services at the International Fund for Agricultural Development, also known as IFAD. So today, I kind of feel like Adam said it well. This morning's sessions has led us nicely into this discussion. We heard about the banking reforms. We heard about financial inclusion, deepening financial inclusion. We all love agriculture for many reasons, so I think this is a great lead up to today's session. So we're going to talk a little bit about the constraints in the agri-finance space. We'll talk about potential game changers in this area as well, hearing from private sector and development partners. We'll talk about digitization, which is key and on everyone's mind. And then we'll also talk about how development partners can work towards unlocking capital for this area. So with that, let me pose my first question to you, Dr. Jonathan. So there's been a lot of excitement, a lot of developments in this space with the roadmap and many things happening in this sector here in Ethiopia and other countries that you're operating. So tell us a little bit, what role do development partners play in this context?
Thank you very much, Anna. Good afternoon to the audience, the panel, good afternoon. I will actually approach that question by focusing on IFAD. IFAD, the International Fund for Agricultural Development, is one of the UN agencies that is actually doing business, right? So IFAD, over the last 45 years, has invested close to $4.6 billion US in the agricultural finance space. And this is about 20% of the total IFAD portfolio in rural transformation. The active portfolio in agricultural finance in IFAD is about 1.5 billion as we speak. Of the 1.5 billion, around 900 million US is in the East and Southern Africa region, and about some 300 million US is in Ethiopia with a project called RUFIP. And RUFIP has been around for the past almost getting to 20 years. Everybody in this hall, you have heard about the microfinance institutions in Ethiopia. You've heard about the RUSACOs. That's been actually the product of RUFIP. So I'm stressing this to actually let the audience know how much IFAD, being one of the 10 international finance institutions that is focusing on rural finance, the most dreaded area where financial institutions, banks particularly, don't want to go to. So I want to indicate that IFAD has been doing a lot of agricultural finance, and the resources that are deployed to agricultural finance are actually used at the macro, meso, and micro level. And at the micro level, which is really of interest to us, IFAD supports activities that really enhance agricultural production and productivity. In this, they bring in youth, women, they look at nutrition aspects, they look at environment, and of course, all across these four themes, they do capacity development. Why am I stressing on this? Because agricultural finance is actually not the mainstream finance, and so we have to do these things to benefit the rural folks. Of the multiple activities that IFAD is involved in rural finance, we actually use or deploy the value chain approach. The value chain approach actually stresses that you'd identify an off-taker market which pays full cost recovery cost and still leave a margin for farmers to be interested in the business that they're doing. So in order to grow finance for agriculture, you need to identify these various subsectors and identify what are their needs. And IFAD's experience in this has been that you need to segment each commodity value chain and make sure that you allocate a particular financial product that responds to that segment. So whenever we're talking about agricultural finance, we should always look at which segment are we trying to finance. When you look at the typical value chain, agricultural value chain in this case, it starts from inputs through production, through value addition, all the way delivery to the market and consumption. Each of these 6 segments along a typical value chain requires a different type of financial product. So what this means is we want to look at the financial products, look at the fact that some segments will need grants, some segments will need quasi-market priced loans, some segments will actually need market price loans. So like one of the earlier presenters said, the rural market space is not homogeneous. It is very heterogeneous, and therefore, each segment requires a different type of intervention. So IFAD, like the other 10 IFIs that are operating in the rural market space, is actually doing this, market segmentation and financing each segment. And in fact, there is a lot to do here in Ethiopia in terms of market research, in terms of, price discovery, because we could finance production and end up not having markets to sell what we produce, especially after everybody has eaten and they're full and there's still an excess. We have to sell that excess, but we have to sell that excess at a cost recovery price. So typically, IFAD is very much involved in this, and IFAD works with the other IFIs in the rural market space, and we actually do a lot, right, to bring the cost down, cost of production, in order to improve the margins of, the rural dwellers. Thank you.
Thank you. Thank you, Jonathan. That's a good point. It can't be a one-size-fits-all approach. It's important to custom and tailor the products that you're providing for all the stakeholders across the value chain. And that's actually a good segue to my next question for Abraham, coming from the private sector. Abraham, can you, by way of introduction, can you also introduce your organization, Lersha, and then respond to the question? Tell us a little bit about Lersha's experience when it comes to unlocking agri-finance in Ethiopia and the work that you're doing with rural farmers.
Thank you, Hannah. Good afternoon, everyone. Lersha is an ag-tech company based in Ethiopia, and we pronounce ourselves as a company that follows a digital model based on the context that we have in Ethiopia. As a matter of fact, context is very important. Adam was mentioning earlier, context is a king in agriculture. And if you take Ethiopian example, we are an agrarian country characterized by over 92% of our smallholder farmer own less than 1 hectare. So when we talk about access to finance, I think the product itself should be designed to fit the context of these smallholder farmers on the ground. So as Lersha, we always promote a one-stop digital solution, providing multiple solutions in one basket, considering this local context. To provide that service, understanding the farmer, quantifying their demand, as well as understanding the land size, the product they produce, and the practice they have is very important. So at Lersha, we prioritize digitizing the profile of the smallholder farmer. These are basic data that build between agricultural service and financial service. Many of the smallholder farmers, they provide service to urban dwellers, and the service is usually far for the smallholder farmers. And this digital profile contain not only just demography and agronomy, but also psychometry, income, and climate information. And then, as you know, many of the farmers, not only in Ethiopia, but the rest of Africa, their access to financial service is less than 5%. And then one of the reasons is the risk financial institutions are mentioning, because these smallholder farmers are not known to banks as well as the microfinance. But when it comes to transaction and credit history of the farmer, the majority of these smallholder farmers are out of the former financial transactions. So at Lersha, digitizing, so far we digitized over 310,000 smallholder farmer across 7 regions of Ethiopia. And these informations are now currently available to multiple banks to make the creditworthiness of the farmer a reality. But again, the co-creation of digital loans that fits the smallholder farmer is very important. With the International Financial Corporation, the last 2 years, we have been working with Dashen Bank to design a product that boosts the confidence of the bank, that can onboard also anchor firm, as well as make this financial service a reality to smallholder farmer. But for many of the smallholder farmer, finance is not the only problem. By providing finance, it doesn't guarantee access to agricultural services. So bundling this financial service to the agricultural service as well as agricultural insurance is very important. And we have done that, and we have seen how strong partnership is very important. In this process, we have learned the KYC requirement of financial institution do not treat farmers differently. The requirements are similar. And the requirement of TIN number, national ID, marriage certificate, land holding is a bit burden to smallholder farmer. So recently we partnered with Ethio Telecom and FSD to onboard the farmer for a national ID. And that is one step to unlock financial service to smallholder farmer. Allow me to mention 2 examples, 2 pilots we did last year. So one was with the International Finance Corporation. We selected a value chain. Not all value chains behave the same way. Some commercial commodities like malt barley, they are convenient to design a financial product. And it also requires a multi-stakeholder partnership. In a way, it was designed as a value chain financing. A financial institution provider, Dashen Bank and Niala Insurance, they provided access to finance as well as a shield towards climate and other diseases. And the technical support from the IFC side was very important to bring these multiple stakeholders in the way farmers are not receiving cash, rather in-kind input. These inputs are, we call them a productive loan, such as fertilizer, seed, agrochemical, and it has to be delivered on time. And fast forward, after harvesting, as we speak, 100% of the loan are repaid by this smallholder farmer. And according to the data we gathered, close to 39% of these participants' income increased, and productivity also increased by 24%. This is a cumulative contribution of providing input on time, providing agronomy support, and leveraging the human bridge on the ground. We leverage agent network. These are the son and daughter of farmers on the ground. When we always talk about digital platforms, we are not expecting farmers actually to download application from the mobile, app store and operate by themselves. These agents are the bridge between the smallholder farmer and the digital platform. I think such platforms' importance are growing over time, and the more access to finance is available on the ground, we have seen that these agents involved in such transaction, their income increased by 60% compared to the other agents. So we have seen that the implementation of digital tools, strong partnership, as well as digital profile, truly increasing access to finance to smallholder farmer.
Thank you, Abraham. Maybe just a quick follow-up on that last point. When you were engaging with the financial institutions, you mentioned Dashen and a few others. In your experience, what was the most challenging part in having those conversations, and what do they encounter when it comes to financing farmers?
I think one is the way how these commercial banks are organized. Most of them, they don't have the agriculture departments. And as you know, when we talk about agriculture loan, soybean behave differently than wheat and malt barley. And also, these loans are seasonal loans. These are not like corporate loans. You have to offer them in June 1, not in June 5. So usually, they are time sensitive. Also, the cost of offering such a service is very high. If you look at any SME providing loan to SME, providing loan to smallholder farmer is 3 times higher than providing a loan to SME. So these financial institutions, one, to avoid risk, the other is to make sure they have in control of the process. They want to do it by themselves. But the cost is very high for them. So context understanding is one challenge. The other is an availability of the product that fits to smallholder farmer is the other one. And the third one is the cost of providing such a service directly to a farmer.
Thank you. Thank you, Abraham. Riyad, I'll come to you now. So the IFC recently launched the Africa Agriculture Accelerator Program, also known as the AAAP, and the aim is to leverage digital technology platforms. Can you tell us a little bit more about the AAAP, its objectives, and its expected impact, maybe across Africa, and then any examples you can bring in from Ethiopia as well?
Thank you, Anna. Thank you very much. Good afternoon, and first, I'm very happy to come back to the lovely Addis and to meet again the very, very kind people of Ethiopia. It's all the time nice to be here, guys. And thank you for hosting us, and thank you for the NBE to give us this opportunity to share some experience. When we talk about agriculture, we talk about an important part of all the economies in Africa, with no exceptions. You did a very good job on Adam on making the assessment. We are talking about a sector that represents 32% of the GDP in Ethiopia. 60% of the people work directly, and maybe 85% of the household, they are involved. And wherever you go in Africa, it's copy-paste. I don't like to say it, but there's no good school on the way. And the lending, it's the smallest one. So the average lending to the agriculture sector in Africa is 3 to 4%. We are doing slightly better in Ethiopia because we are at 6%. And that's from where we started thinking to design the AAA, the Africa Agricultural Accelerator Program. First, to focus on food security. We, the IFC, we support the agriculture sector through 2 departments. Our colleagues from the Mass Agribusiness and Service Department and the Finance Institution Group. And together, we GVs to design this program. The main objective of the program is to leverage technology to transform agriculture. So, two information that matters to understand why leveraging technology is key. So I gave the numbers of the percentage of population involved in agriculture in Ethiopia, and it's the same case in all Africa. 80% to 90%, like in Ethiopia, of the farmers, they are smallholder farmers. So not only we need to unlock access to finance to farmers, but we need to unlock access to finance to millions of farmers. And the main objective of the AAA program is to support food security agenda by increasing productivity and increasing through the productivity the productions of the main food security crops. We focused on wheat, maize, and rice, but there's no exclusion. In Ethiopia, we work, for example, with Kifeya on potatoes. With Abraham, we work on maize and wheat, and many other crops. So there's no limit, but the wheat and the maize and the rice, they are the main crops to feed the population and the animals in the continent. So the only way to leverage and to really unlock access to finance to millions of farmers is to learn from what we did in the mobile money industry, where technology helped Africa to increase financial inclusion from 17% in 2014 to many countries they have. And we are in Ethiopia, the data that was shared, we are between 65 to 70%, and in East Africa we are with an average of 60%. So same things, the idea is how to leverage technology. And we built the model around, let's say, first the design, it was designed about 4 pillars, which now, number 1 is build a network of agtechs. We call them the smart aggregators. What Abraham was explaining, he's aggregating 300,000 farmers. So only through agtechs you can reach that level of numbers. And when we did an assessment about the available technology in supporting agriculture in Africa, we realized that there is many nice experience. In West Africa, agtechs, similar to Abraham or to Kifeya here, model, they are managing, for example, Babanguna, around 200,000 farmers, and we find that their farmers produced 2.5 times more and better than the national average. And when you produce more, and you make more incomes, you transform agriculture and the farmers on commercially viable business. And that's, I think, it's one important steps in unlocking access to finance. And also there is Thrive Agri, and we find similar examples that if we leverage the AgTechs, we can, number one, improve the productivity of the farmers and increase productions. But also, we were able to think about it. So number one, we leverage the AgTechs. Number two, the access to finance can only come from financial institutions, microfinance and banks and NBFIs. So we designed a commercial solution, but to ensure that access to finance will be leveraged by financial sectors, we need to resolve the problems of why the banks, they are not financing. So I don't think that the banks do not like to finance, but they need the minimum of tools to enable them to de-risk the smaller farmers and build the portfolio of it. And that's where both the AgTech and IFC, so the AgTechs, they are, Abraham said two things very fast, but they are key. First, they're able to do a KYC using their technology. So that's the first step to know the farmers and know the experience of the farmers and all the information that is needed to know the client. Number two, they profile the land through satellite image. You know, in the previous panel, they talked about how technology can help in developing agri-insurance. So when you profile the land, not only you have a very transparent estimation of the needs in terms of working capital, but you can build the historical of what happened in that piece of land for the last 9 years. The average is 5, but you can go to 9 years. And we start building data that was not available in the market for the banks. And we leverage the data by an additional things that the aggregators, AgTech, can do, which is manage the entire value chain. So we need to work with the SMEs providing seeds, with the SMEs providing fertilizers, with the SMEs providing equipment services, and with the anchors. And IFC designed a de-risking tool through the guarantee portfolio, where we can support the banks through our tool to de-risk the entire needs, means the smaller farmers, but not limited to it. You need to ensure that all the value chain will be fed. So imagine that we are putting money in the entire value chain, so we are bringing cash that helps the AgTechs like Abraham to reduce the cost, because aggregation reduces the cost because we pay cash now, because the smaller farmers, they have access to finance, but also to get the best quality of everything. Today, the farmers, without having money, they will buy whatever they find to farm. So we are improving through the AgTechs aggregator the entire quality in terms of starting from unlocking the access to finance in terms of needs, and then securing the harvesting. And the AgTechs, they are doing an additional good work. The intermediaries disappeared when it's about buying the harvest from the farmer. And we bring the best price because they improve the quality of the production. So if you reduce the cost, you increase the price, you increase the productivity, then you made the first step on making the farmers commercially viable. And this is what we are doing. And we did a lot of pilot, and it's working. In Morocco, it's working, same results, increasing the income by 50%, increasing the wheat production of our pilots by 30%. And what we are doing now, in order to feed the financial institution by a sustainable tool, we have an advisory work. So we support through advisory the AgTechs, but we provide technical assistance to both the AgTechs and the banks to learn how to work together, including the agri-insurance because it's key. But in addition to that, we are building a credit scoring based on the data, the new data generated by the AgTechs, to become a credit scoring tool for the banks so we can scale up. Because we pilot, we learn how to work together, and then we scale up to reach the millions of hectares. So that's what we are doing. The appetite of the AAA program is to finance 5 million hectares through wheat, rice, and maize, and that should reduce the importations of these crops in Africa by 20 to 25%, and that's what we are trying to do. And one of the things that we are doing, for example, at market level, and it's nice to have Excellency the Governor here, we are even building, for example, in Morocco with the Central Bank, with the Credit Bureau, an agriculture Credit Bureau unit. So we can also sustainable the data that we can inject for the financial institution to sustain the lending to the agriculture sectors and to the AgTechs. So today, the technology is giving us this opportunity. I will not be here maybe 10 years ago to talk about it, and thanks to the technology and to all of these young talent people. You know, one of the learning that I have is that technology is bringing young talented people to agriculture, which is great. Thank you.
Yeah, thank you. Yeah, you can clap. I think that's a very good point towards the end, because agriculture has always been marked as, something that, the older generation is embarking on. But now, as we can see, there are much more younger generations being involved in agriculture. I'm going to pause here and take some questions for the audience. If you have a question, please raise your hand and just introduce yourself, your organization, and then just address who the question is for on the panel. I see there's one over here, and then one over here, and then we can take one from, and then one over there. Perfect. So we'll start on this side. Is there a microphone? Is there a microphone for the questions?
Okay, thank you. My name is Teshoman from Microfinance, Busagonofa. My question goes to Abraham. Specifically, I'm aware of some of the work you are doing with respect to smallholder farmers. When we talk about okay, before that, sorry, I'd like also to congratulate the organizers. It's quite after a long time ago that I've seen such kind of very high level, but also very diverse forum being organized. Really, I would like to congratulate you. So, my question is really for Mr. Abraham. You are working with smallholder farmers. In Ethiopia, when we talk about agriculture finance, I think we talk about smallholder essentially. Now, my question is, in terms of the role of banks, not microfinance, but in terms of role of banks in financing, when we talk about smallholder financing, which is, for me, I understand, roughly around 90% of them, who are producing almost 90% of the food production in this country, are cultivating on a land scale size of around 2 hectares or below. That's my assumption. Now, assuming this size of scale of production, when we talk about banks financing or agriculture financing, what does that practically mean? Are we setting probably unrealistic expectation, or practically what kind of modalities is going to be really attractive but also sustainable for a bank to finance that type of business scale, business size or agricultural farm size of 2 hectares or below? Thank you.
Thank you very much. And then we'll come to the question in the middle over here. And then, unfortunately, this is going to be our last question because we are running out of time.
Thank you very much. I'll be very quick. I did a research on MFIs and the agricultural sector about a few months ago, and I observed that all the efforts that they have been doing for agriculture, and specifically small-scale agriculture, are not grouped to the climate change. And I think this is a very dangerous issue, because unless we know what we are doing in agriculture in relation to climate change, I think we are not going to move in the SDG. The second issue is, apart from lower productivity, which it should be enhanced, as you said, I feel that one of our problems, specifically in Africa, that we are depending on subsistence small farming. We are not really looking for, medium medium farming by amalgamating or grouping together small farms and give all the necessary support and finance to them in order and move away from subsistence to production for the local markets and the export specifically. The third issue, while you are talking, I remember the Global Small Farmers and Food Security Flagship, which ACFANT, in which I'm working as a senior advisor, together with Badia and Innovation Commission of the University of Chicago, has signed in the last COP 16 COP in Ethiopia. There are about 25 big companies, all about, the flagship is talking about innovation in agriculture. And I think 15 African countries, they are now joining the flagship, in addition to about 25 international well-known companies that bring innovations to agriculture are now part. And the Arab group, Arab Coordination Group, has also declared $10 billion up to 2030 in this program. I think Ethiopia should be part of it, and I don't know whether there is anything you know about that or not. Thank you.
Thank you very much. So I think those are 3 good questions. Maybe each of you can take the questions. Abraham, on the first question regarding smallholder financing, and then maybe Riyadh, you can take the last one on the flagship program, if you're aware of that program. Yeah, and then Dr. Jonathan, maybe on the low productivity question, you can take that one.
Thank you, Ato Tashoma. Ato Tashoma is a very seasoned practitioner in the MFI area who really has a hand-on experience on the ground. I remember 6-7 years ago when we started this Agri-finance, he gave us a hand-holding, and thank you for the question. Of course, MFI play a big role in the Agri-finance, where they contribute over 80% of their loan goes to agriculture. But if you look at the previous MFI now converted into bank, their agri-finance portfolio dropped from 57% to 32%. That indicate banks are not organized to provide agricultural services for reasons including what you have said earlier, not only land size, but also the characteristics of the smallholder farmer, which include unavailability of data, also the literacy issue. You know, smallholder farmers are not in a position to negotiate with an officer of a well-organized commercial banks. So I think we, as much as we understand the role of MFI, additional funding to this agricultural sector is very important. That's why we are pushing commercial bank also to come to the agricultural sector. The data-driven model is one which is important to attract commercial banks like the one I mentioned earlier, because MFIs are very close to farmers geographically. Their branches are located at a Kabale and Warada level, but these banks are a bit far from the smallholder farmers themselves. So when we are saying we are working with commercial banks, profiling the smallholder farmers will help banks to understand who the farmers are, what are they producing, who are the buyers of these commercial products. As Riyadh mentioned earlier, we first sign a contractual agreement with the anchor firms before even we onboard the smallholder farmers. That provide confidence to the banks to allocate fund. And then probably I want to connect also the second question, which is very important about climate change. 80% of Ethiopian agriculture is rain-fed, and if we get a single climate shock, the whole production will be wiped out. So that is one of the reasons why financial institutions deprioritize providing financial institution to farmer. But in our model, one, we build early warning system. We don't have the system itself, but we work with the research institution, including the Ethiopian Agriculture Research Institute, ATI, and Ministry of Agriculture, to provide a climate advisory. It's an agro-climate advisory in a local language, multilinguistic, in both SMS and voice blast. These are disseminated to farmers every 2 weeks. This early warning system help farmers to make a proper decision. If a rain season is very long, then farmers will decide to choose a proper variety of seed or a proper value chain. The second one is bundling agricultural insurance. In case the climate shock happen, then that will shield the smallholder farmer. I see Mr. Yared here from Niala Insurance. The last 2 years, we partner with them to provide somehow a bundled insurance to smallholder farmer. When a loan is approved, then insurance is compulsory and it is included in the loan itself. Because insurance is not a standalone product. and awareness and distribution are some of the challenges when it comes to the insurance product. But I'm sure Riyad has something to add.
Bram, you are brilliant. I will add a few things. First, I think it's discriminatory when we promote only the model as a data-driven model, because the aggregation is a key support for the smallholder farmers from from starting from seeding, preparing the lands to the harvest. And I think that's what brings lots of comfort. You know, agriculture is not only about agronomy and weather. Agriculture is about supply chain. 300,000 farmers farming wheat. It's around 200,000 tons of inputs to be delivered on the right time from the right suppliers. So the aggregator is bringing lots of add value to the farming exercise. So that's why it's, you are humbled by saying it's only data-driven, it's beyond that. And I think the de-risking, by the way, starts from a macro exercise, because thanks to the technology that they are using drones technology, satellite image, they can, based on the data that they can collect from the satellites, they can identify what we call the favorable zone within at the country level. For example, in Morocco, we did an exercise because Morocco is facing a very tough drought situation. Within this drought tough situation, we were able to identify with the AgTech the 1 million hectares favorable zone. So there's a lots of work before even we started identifying, they started identifying the farmers that can help the banks to feel more comfortable. And the other thing is the agri-insurance. So IFC, we have in Africa a $10 million advisory program to promote agri-insurance, and we are working to promote agri-insurance in Ethiopia. So for example, under the model that we are working with and partners, as I said here, the two architects that we are working with is Abraham in the panel, and I see Munir sitting and hiding there. One of the things that we are doing is we try to promote, to ensure that with every single loan signed by the bank and the agtechs, there is an agri-insurance supporting the crop cycle for a given farmer in a given land. So that's what we try to do. I'm not aware about the initiative that you spoke about, but as I said, climate change is a risk, and it cannot be covered by the agtechs, and it cannot be covered by the bank risk assessment. That's why I think Pula spoke about, and we have Pula, but we have many insurance companies that we are working with. I think the agri-insurance for now, it's a good mitigation, and even in West Africa, when it's different. For example, in Senegal, we went through, there is what we call the flood risk, and even the flood risk was covered, and 1,000 hectares in our first pilot was nicely and fully paid by the agri-insurance. So when we have a real agri-insurance industry, and we need to have it, because like I said, it's not about financing 300,000 hectares. We have 6.2 million hectares farmed on cereals in Ethiopia. So we need to have this integrated approach. So by the next coming 4 or 5 years, we reach really industry that can scale up to cover the entire. And by the way, the deficit of cereal in terms of food security in Ethiopia is around 27%. The improvement of productivity can help Ethiopia to export 27% of the production. And the market needs is huge. I think yesterday, we were talking together and we said what we do with the excess. I said I would love to see Ethiopia our Ukraine for Africa. Why not if we improve productivity?
Thank you. Thank you so much. Unfortunately, we do have to wrap it up there. I think this topic deserves an entire day on its own. So thank you very much to our panelists. Please give them a warm round of applause.
And thank you to you, Hannah. A warm round of applause indeed. Thank you very much, esteemed panelists. Sorry we have to slightly curtail this very interesting conversation on agriculture. You're absolutely right. We could talk the whole day on this very interesting and important subject. I'm going to ask Hannah if you and your panelists could take a photo. Camera people, photographers, if you could take your position so we can get a photo. And then we're going to move on very quickly. Thank you again, Hannah, for the excellent moderation. Off the back of this very insightful discussion on agriculture, the bank would like to take this opportunity to launch and introduce to you the National Agri-finance Implementation Roadmap, NAFIA in short, which aims to enable the scale-up of agri-finance in Ethiopia. The roadmap proposes a package of transformative solutions that will integrate and energize Ethiopia's emergent agri-finance landscape through a 5-year implementation plan. A QR code is projected of a draft version. I'm very glad the QR code is there. A QR code is projected of draft version prepared for the forum. You can now scan with your devices to access a copy. So if you have your phone in your hand, which I know most of you do, you can now scan the QR code on the screen to access a copy of the roadmap. The National Bank of Ethiopia welcomes your feedback on this document. Congratulations to all the stakeholders on the launch of the draft document. All right, let us keep going. The National Bank of Ethiopia is pleased to announce the inclusion and encouragement of non-bank investors, including retail investors, in the T-bills market. This initiative is part of ongoing efforts to strengthen the primary market by diversifying the investor base. This strategic move aims to broaden market access, enhance financial inclusion, and support the government's efforts to mobilize resources from the market. Ethiopian Investment Holdings is one of the non-bank participants resulting from recent government initiatives. They participated in yesterday's T-bills auction and invested 7 billion birr. As a result, they would like to acknowledge their participation by presenting a treasury bill certificate worth birr 7 billion. To mark this milestone, I would like to invite His Excellency, the Governor, and the CEO of Ethiopian Investment Holdings, Dr. Brooke Tai, to officially exchange the government treasury bill certificate issued by the Ministry of Finance. So, Your Excellency and the CEO of the Ethiopian Investment Holdings, Dr. Brooke Tai, to officially exchange the government treasury bill certificate issued by the Ministry of Finance. Photographers, if you could take your positions for this moment whilst we observe this exchange. A round of applause on this occasion. Thank you very much. Great.
Thank you so much. So I just want to say a few words, to say how and why this is so important for us. This is a very, very important step and departure in Ethiopian financial sector, partly because traditionally, when it comes to the budget deficit, the National Bank, as the physical agent of the Treasury, the government, used to sell Treasury bill only to two important players. That is to the banks and to the pension funds in Ethiopia. So for the first time, apart from the banking industry and apart from the pension fund industry, we have an investor in Ethiopian Investment Holdings, the state-owned sovereign wealth fund that we have in this country, investing in Treasury bill. For us, this is a testament, number one, to the confidence that AIH has in the treasury bill market. The second important value of this transaction is now we can move toward this non-inflationary source of finance for the budget deficit. So this is a very, very important step, and it's also a historic step. Going forward, because we have so-called CSD, the Central Security Depository Infrastructure, which was launched recently, we'll open this up to retail investors, to individuals, people like yourself, to directly invest in the treasury bill market and buy treasury bill markets going forward, like we see in other countries where they have a modern financial infrastructure. So this marks an important step where the treasury, the government, is mobilizing finance, not just from the banking industry and from the pension fund, but also looking as a potential source of finance, including commercial public companies like AIH, and also insurance companies and retail investors like yourself going forward. So this is an important milestone for all of us. And I want to thank AIH, the CEO, Dr. Brook, for taking this idea so enthusiastically and invest in the treasury bill market. Thank you so much.
Thank you very much, Your Excellency. A round of applause for the Bank Governor and the CEO, Brook Tai of Ethiopian Investment Holdings, Dr. Brook Tai. Thank you very much, gentlemen. Okay, let us move on to our next very exciting and interesting panel. As Ethiopia advances its financial sector reforms, innovation in insurance is emerging as a critical enabler of financial inclusion. This next session is going to explore how digital transformation, microinsurance, and regulatory advancements can expand access to affordable and inclusive financial services. I would like to take this opportunity to welcome our panelists, Eduardo Totololo, Vice President, Research Center for Financial Inclusion, Lynette Odera, Chief Officer, Public Sector and Inclusive Solutions, ZEPRE. Please welcome them as they come up with a clap. Thank you very much. Mr. Yared Mola, the CEO of Nayala Insurances, and Mr. Elias Omondi, Principal Innovation for Resilience, FSD Africa. If you could please come up to the stage. And to moderate this session, I would like to invite Mr. Belay Tulu, the Director, Insurance Supervision Directorate. Thank you very much.
Good afternoon. Thank you very much, and I think we are going to make sure that we don't pay a claim on taking more time. So Elias Omondi is my name. I'll quickly take you through a very short presentation that kind of brings into space what we'll be discussing this afternoon. Right, if you ask yourself, when we talk about insurance, there's one big component that most of the time we don't talk about, the missing middle, and that is what this particular presentation is going to set pace in terms of how then insurance can critically change the landscape of the financial sector. Importantly, we've talked about different impacts around the financial sector, but insurance really plays a critical role in terms of managing risks and building the sustainability that is needed throughout the continent. Maybe just to start, it is really, really important to set pace. What are some of the challenges that we see? Now, the challenges within the risk transfer markets fall into three main buckets. There is issues around weak demand, and when we talk about weak demand, is that many people still do not have an understanding what is the importance of insurance, and that is spread across different parts of Africa, and I'm going to kind of lay a bit of statistics in Africa and what we see in Ethiopia in terms of affordability, in terms of trust, also in terms of just inconsistent public budgeting, in how then we can address some of the risks that we see in this particular sector. The second element is on low supply in terms of the instruments. that people can purchase when it comes to insurance. And you can see that there are areas whereby the insurance companies are not really developing solutions that do speak to the needs of the people in terms of their low margins. They're not accessing different sectors that really require insurance. Importantly, we've heard about agriculture, whereby insurance can really play a critical role in terms of enabling that particular sector to grow and to thrive. Then encompassing all that is regulations. And we are going to talk about what do we really need to do when it comes to regulation to enable this particular sector to thrive, because the sector also has highly restrictive regulations that really needs to be enhanced to ensure that we spread and enable this particular sector to work. Now, if you look at where we are as a continent, in terms of the contribution of insurance to the gross domestic product, Africa sits 50% down compared to the world average. There's around 7% of GDP contribution that insurance brings into the sector, but in Africa, less than that is what we experience. We experience at least 3%, and we're going to see then what is the contribution of insurance that this particular sector brings into the national government here in Ethiopia. And in the retrospect, then you kind of see that Africa is 11 times down compared to the world average when it comes to the insurance penetration per capita. That means that we are hugely, hugely exposed, and also this is a continent that requires a lot of protection that really needs us to really think about how insurance can enable us to cope with emerging challenges that the world is facing. Now, if you look at this particular challenge, there are 3 A's that we will be talking about in this particular panel. One is issues around awareness. Are people aware of insurance? The second element is affordability. Most of the time, insurance is quite expensive, and we really need to think about how we can make it affordable. And thirdly is what we call the accessibility. Most people cannot really access this particular product. The insurance premiums in Africa is kind of shrinking. We were at around $73 billion. Right now, we are at around $63 billion. And over 80% of these particular premiums are contributed by only 5 countries. That basically tells you out of the 54 countries in Africa, they only contribute up to around 19 to 20% of the premiums that are kind of generated in this particular continent. Now, there is a big opportunity. So, for instance, we've just heard from the panel that agriculture presents a very big opportunity for the insurance sector. There are issues around healthcare. People still need to access affordable healthcare. There are issues around housing, energy, and transportation. These are some of the key proponents that will be able to help the insurance sector not only to navigate the challenges that we are currently facing, but also to help these particular sectors to address these particular challenges. There are a couple of solutions that we are going to talk about. Innovation is one of them, and it will enable us to provide these particular solutions and address the challenges that we are talking about. Now, the insurance sector in Ethiopia has had a very, I would say, interesting journey, whereby currently the contribution of insurance to the GDP is around 0.27%. It's still below a percent point. And this basically means that there is need for us to really look at how best we can address these particular challenges. Now, gross premium is increasing, and that is great, but it's not increasing as in the right pace at how the economy is growing. Now, for us to protect the economy, there is need for the insurance sector to thrive and to ensure that this particular sector supports the economy in terms of what we are likely to see into the future. There are quite interesting numbers here. In terms of the number of people that are insured in Ethiopia, we can estimate that around 8.7 million people are insured, and that basically presents only 10% of the insurable population. Now, there are quite a number of opportunities that we see around these particular numbers. If you look at the number of people that are earning income, and these people can, in one or the other, have access to insurance solutions, we can see this at around 36 million people. That really presents a very big opportunity for the insurance sector. Then if you look at those particular groups that are formally organized, around 43 million people in Ethiopia have formalized groups, and also this presents a great opportunity for us to provide to them insurance solutions. But in terms of those particular people that are financially included, you can see this number goes to around over 50 million. Now, there are those people that are quite difficult to reach in this particular space. And these are some of the things that we are going to explore on how innovation can enable us to reach these particular people, as we also look at the opportunity that around over 50% that can be insured really need to be provided with these particular insurance solutions. We can say that around 90% of people in Ethiopia that should have insurance are still not yet insured. And that basically presents a big untapped opportunity for this particular market.
Elias, you are left only with 2 minutes.
Fantastic. Now, maybe just to look at what does this really mean to us. So there are issues around awareness that really needs to be addressed. There are issues around irregular saving culture that needs to be addressed. There are issues around mobile access that also kind of we already see a number of people that are having access to mobile solutions. But importantly is issues around limited financial literacy that also really needs to be built when it comes to the insurance sector. But this kind of also brings a number of opportunities. We kind of see that stress is a major barrier, but in terms of how then insurance sector plays and kind of operates with other financial sector players, MFIs, builds a big brand in terms of enabling this particular sector to work. There are also a number of areas that in Ethiopia, there are people that are already aware of risk sharing. For instance, that idea solution that is currently having a big opportunity for the market, but also really looking at how then we can ensure that we meet this unmet insurable risk. Just to conclude, we need to look at these 6 areas. One is that already there is an existing infrastructure that can be used to enable insurance to thrive. We have a lot of young people. Talent is also available that we can really use. The issues around market engagement, we are seeing a lot of market engagement from the Association of Insurance to different sector players. FSD Ethiopia is doing a great job in terms of enabling some of these things to happen. The World Bank and the rest of other development agencies, and also enabling access to finance has been critical. But importantly is a supervisory support that really needs to come from NBE, the National Bank of Ethiopia, to enable this particular market to thrive. Just to conclude, for us to make this to happen, there are 2 great facets that need to be enabled. One is on the market development side, whereby regulations have to enable innovation and development of new insurance solutions. But on the other side, we need to improve protection. That is whereby we need to kind of modernize the insurance law to ensure that customers that are going to purchase these particular solutions are clearly protected in terms of how then they are going to receive their benefits at the end of their period. So as the market changes, this is a big opportunity for all of us to build a proper developed market, but also to ensure protection by modernizing the laws that we have. Thank you, and we can start the panel discussion.
Thank you, Elias, for the time management. This program particularly takes us to, in my view, into a new territory or a different territory. We have been flying at 35,000 altitude. Now I'll take you to the ground. And as you have heard from Mr. Elias, the insurance sector across Africa has not developed well. Particularly, there are a few countries who took majority of the African insurance market, and there are different problems for that. And today's theme is what can innovation can do to unlock the potential and to provide risk management solutions for the underserved or for the unserved segment of our society. So having said this, dear panelists, welcome again. And I'll give you 2 minutes for each question because we are paying the dates that have been accumulated prior to us. The first question would be Mr. Eduardo. What is the main concern of insurance regulators or finance sector regulators in general as far as innovation is concerned?
Is the 2 minutes negotiable or not? I prepared for 5. Okay, I'll try to go fast. But I think, first of all, thank you. And I think this is a very, very important panel that, as we see all morning, we talked about so many innovations, but somehow insurance is the first time that it comes up in this session, and also in the previous session when we talked about agriculture. I think it's an incredibly important theme. When it comes to regulation of innovation, what are the key concerns? I think that generally, anytime I've engaged with regulators, they're not anti-innovation. They usually are anti-consumer harm, they're anti-unfair practices, they're pro-stability. Now, finding and striking that balance between the two is that incredibly difficult job that I'm sure you know very, very well. Now, what are the key worries? I would say one of the key worries is definitely that fast-moving innovations make risks harder to see and to supervise. Right now, as we see innovations in the financial sector more broadly, but also as we see new innovations in insurance, we see bundled products, we see hybrid business models, we see the use of automation, algorithms that often operate in a black box. We don't know what data they use, they don't know whether they have bias, they don't know really, it's very difficult to interpret them. In this context, it becomes very difficult to assess what the new risks are, how do we, what can we do, and what can regulators do to mitigate them, and whose responsibility is it when we have these bundled products that merge financial sector, insurance sector, and non-financial sector players. So I would say that is definitely one of the big questions that we face. A second one is one about asymmetry. Innovations in inclusive insurance often try to target those who are underserved, those who are digitally inexperienced, but regulators worry that the risk might shift to those who are least able to bear those risks. And in some of the research that we have recently published that looked at various global markets, including Addis, we saw that that level of experience in digitization are still quite low. We saw the numbers growing, we saw some great numbers earlier, but if you look at what entrepreneurs, what households are using in terms of digital tools, they're still at the very early stages. I think one last point, I hope I'm still within the 2 minutes. I think regulators really worry about what I would call the silent failures. A poorly designed insurance product may never trigger a complaint from a user, either because the user doesn't know how to complain, or maybe because they don't think that anything will happen from that. And that is important because that doesn't create any headline. Nobody talks about that, but at the same time, that causes the erosion of trust, which I believe, among the many challenges that Elias talked about earlier, I think is the one that is most important and where regulators need to be actively involved.
Okay, thank you, Mr. Eduardo. You hit the nail right at the head. Yes, the main concern of regulators is to maintain or to strike the right balance between innovation and regulation, because their primary responsibility is protecting the policyholders, but you cannot protect the policyholders unless you have appropriate, affordable, and suitable products at the same time. So my next question is to Lynette. It's a generic question, but I hope you will respond to it within the context of the insurance market and innovation in the insurance market. Why do we need, in your view, insurance market innovation in the first place?
I think I'll start by thanking the organizers of this event for inviting ZEPRI to be part of the inaugural financing forum. And thank you to Elias and my dear panelist, Eduardo, for setting the scene for me. So I'll try my best not to regurgitate what you've already communicated, but rather complement the very strong points that you have put across from a reinsurer's perspective and possibly sharing very practical examples, in particular because as ZEPRI, financial inclusion is at the center of our growth strategy. And so for those of you who are not aware, ZEPRI is a COMESA institution that was established by governments to foster insurance and reinsurance business. And so our functional mandate is really to drive insurance penetration, but also to stimulate financial inclusion and resilience. So for us, it's both a business strategy and an impact strategy, and that allows us to sort of achieve our mission of growing Africa's financial resilience. Now, to your question, Atobelai, innovation and why it's centered to everything that we do, it's because it creates a pathway to protect those who would otherwise not have access to insurance. And it is also an opportunity for growth for the insurance industry. It is indeed would be considered a new revenue channel for the insurance sector. And through innovation, there is the opportunity to create new solutions, and of course, that respond to the needs of the underserved. For us at ZEPRI, we believe that as we get into financial inclusion and inclusive insurance, we are expanding the circle of protection, not just for ourselves as a business, but for our peers, because for how long will we focus on motor insurance and all the other mandatory insurance when the world, the people, the businesses, the country needs us to come up with more innovative solutions. So why I will start by saying why it's important. Insurance is important, and innovation, therefore, is important because it unlocks and enables development. And number two, it sustains and preserves development. I'll start with very quickly why and how insurance unlocks. That's noted, unlocks development. As you know, why traditional or conventional insurance is not designed for a certain segment of society, because as you've heard from everyone, they are considered or perceived as being very risky. And what is risky? Risky is potentially, in the world of access to finance, the inability of those who financial institutions have extended a facility to not being able to repay back, or potentially not having very attractive return on investment or capital. That is risky for financial institutions. And so this segment of society is considered risky because they are actually just one health, one climatic shock, one economic shock, one pandemic away from either falling back into poverty or losing the development gains that they may have achieved. And so insurance, in this case, the role of insurance is to de-risk that segment of society and allow them to carry on, or allow the insurance sector to carry on that risk on their behalf, so that they can access finance and then enable them to participate in economic activities. I'll speak very briefly about the preservation, because someone mentioned, I think it was my neighbor where I was sitting, that there is a lot of effort that has gone into access to finance in the agri sector and many other sectors, but we don't seem to be seeing, I think, the results of that. I'll give an example. What does it benefit a farmer to be able to access financing for their input, for their fertilizer, for their, but then in that case, because they have insurance and now they can access financing, the bank is protected. But what happens when that flooding or that drought occurs? They completely lose it. So how are we backing up the access to finance? We need to preserve, that takes me to my next point, we need to preserve and sustain the development gains that have been achieved through access to finance. And that's, very quickly I'll mention that at ZEPRI, we keep talking about insurance and how insurance can come into play to de-risk these sectors, whether it's MSMEs, I've had MSMEs so many times today, but you need to realize that even for the insurance sector, the kind of capital you need to get into climate risk finance is really patient capital. So you'll not find every insurance company or reinsurance company eagerly waiting to take on that risk. And so we need to discuss that as well. So at ZEPRI, as I said, financial inclusion is both a mandate and an expectation from our shareholders, the governments that own us. It's a bold step for us, and there's a lot of investments that goes into producing or designing these types of risks, which not every insurance and reinsurance company is willing to get into. I'll speak very fast about one of the MSME resilience. I'm out of time. Okay. Thank you.
Sorry to interrupt you, but we have to maintain.
That's okay. That's fine.
Okay. So the next question would be to Mr. Yared. Mr. Yared, who are the key actors in the insurance market landscape, and what distinct role can they play in promoting innovation, inclusivity, and development? I hope you'll take only 2 minutes.
You took half of it. Thank you, Otobele. I think this is a very good question, and it will really show how insurance is distinctive from other financial institutions, because our actors are various, and all the ecosystem players. Actually, on the advent of digitalization, the ecosystem has been turned into somewhat circular mode now, but I will, for the sake of explanation, I will use the straight line model. There are various actors here. Number one, the customers or consumers of insurance, then the intermediaries, then the insurance companies, then the reinsurers, and it all goes on. Let's start by consumers of insurance products. Everybody here, all of us are insurance consumers, and our contributions are very high for the innovativeness and inclusivity of insurance products itself. For instance, how are we looking for being seamless services instead of being price-based services? Or how do we look, for instance, all the millennials, Generation Z, they're avoiding all the face-to-face contact. All they need is cost, or efficiency, and convenience rather than. So the consumers themselves push and ask for the innovation of insurance. And then intermediaries. Intermediaries are the one who always educate and try to just break the gap in the insurance literacy issues and awareness issues. So they need, instead of focusing on major towns, commercial business, they need to go and on rural areas to focus on those who cannot really enter into the insurance sector. And the main burden also on the third one, the insurance companies. There are two things that they need to do also here. Number one, innovativeness, innovative products, basically on the basis of digital, or digital transformation based. There are a lot of products being introduced. And also we need to focus on some inclusive insurance like micro-insurance, parametric insurance, and the likes. Otherwise, most of us were based on focusing on our profits, so we need time to, there is profitability pressure issues. I think it's worth here mentioning, Abraham from Lersha earlier mentioned that, he didn't mention that for the last years, for instance, we've been working with, Niala Insurance has been working with Lersha, but how much we gained from those years? We have worked for so many development partners. Nothing. But it is our passion. It needs also passion to work for the inclusivity of insurance. Then we comes to the reinsurers. Reinsurers also, instead of taking the cream of the insurance premium, they need also to support the local insurers to invest on diversities, to invest on inclusive insurance programs and the likes. And then comes the most important element of the regulator here. Regulator, other than preparing the regulatory sandboxes and innovative products, they need also to understand the market dynamics, what insurance is. By the way, let me take this opportunity to quickly appreciate and thank the National Bank and its governor, Governor Mamo, for understanding the current problem of insurance, and of course, to allow insurance industry to have an independent regulator. So to understand the clear dynamics, how it has been regulated, and then to support. And there are a lot of also other issues like mandatory insurance who's been left out of, for instance, pension schemes. It needs to be also included in insurance. I think I need to have to go on, but I've seen your signs, so maybe if I have the chance, I'll come back again. Thank you.
Okay, thank you. Yes, there are different actors or players in this endeavor. We can talk of the conventional insurance industry, infrastructure providers, technology service providers, and the regulator. All of these parties have significant role in promoting innovation. So my next question, the first question is to Eduardo. To what extent can innovation be leveraged or entrenched into the fabrics of the unserved or underserved market segment?
Thank you. I'm really glad that you're posing that question, because I think that out of the many stakeholders that you just listed, I think that understanding demand for protection is really where we have a very big gap. That's where a lot more work is needed. Very often when when the industry tries to innovate, really tries to innovate for the underserved, rarely it does that with the underserved, with that intention to understand really the realities. So we recently conducted research, kind of trying to ask some of these questions, trying to see what is the demand, how do we think about it, how can we use that knowledge to then drive new innovations. Many findings, a few that I can squeeze in 2 minutes, knowing that you're a firm enforcer. I can see you're a supervisor. So the first one is that, well, one of the things that we found that I think is important is that most users, most entrepreneurs, we focus in particular on the demand from small-scale entrepreneurs. They already pay for risks. They just pay in very inefficient ways. Usually when a shock happens, they pay by depleting their savings, they pay by losing their income, they pay by borrowing a high-interest loan. All of these are very inefficient. Now, as we think about the value proposition, I think we very often focus on the element of affordability, which of course is very important, but the willingness to pay, when we contextualize it within the trade-off that they make, in the sense that it's not that this comes for free, it comes at a cost. That cost is not factored in the insurance purchase decision. So how can we as an industry and as researchers, as regulators, think about these trade-offs more concretely so that you can provide that as a tangible choice where people understand that actually they're making a choice even by not purchasing insurance. A second point that builds on that is we're coming with the hypothesis that, that trust more than cost is the key barrier that we need to address as regulators, as industry, as research, as a development community. We found that a single denied claim that is perceived as unfairly denied, such news travels through a community faster than any marketing campaign ever will. And on the contrary, when there is an insurance payout that is provided to a person in need in a community, that drives more enrollments than any radio advertisements or any brochure ever will. So I think that as we think about insurance, we need to think a lot more about the claim processing part of it. It's not the entire product, but that part is very, very important when it comes to building the trust that is needed. When insurance works, it does drive confidence, new behaviors. We see that, we often think about insurance as that financial service that if something happens, that you'll have some cushion. But even just the knowledge of that cushion helps entrepreneurs become more confident and make that extra investment, take that extra training course for upscaling, reskilling, or keeping that business open when there is an emergency. So I think that as we think about the value proposition, yeah, it's the direct cushion, obviously the score, but there's also other elements that often we don't factor in. I think in terms of opportunity, I think ultimately we'll need to find ways to embed insurance and embed risk protection more broadly into basically the places where people already engage. Right now, if you think about what we know about Ethiopia, but many other markets in the African context, those are informal sharing networks, they are credit cooperatives, savings groups. Those are very effective, but not sufficient, because when a shock hits a community, everybody is affected at the same time. So the efficacy of these risk-sharing networks is very limited. I think eventually what we need to think about a lot more is how do we embed in the digital economy effectively. People are, as we've seen this morning, are increasingly using mobile money, digital payments, e-commerce platforms, social media platforms. Those are the places where insurance and protection can be provided seamlessly in a way that I think will drive enrollment, will drive uptake a lot more.
Thank you, Eduardo. And my next question is to Mr. Yared. Mr. Yared, do you accept the notion that incumbent insurers or the conventional insurers are blamed for largely focusing on digitalization of their processes to better serve their existing clients than finding innovative ways to enter into new markets is acceptable?
Yes, I think this is a widely recognized criticism. Process innovation over market expansion. Less focus on inclusive insurance and more focus on commercializations. I've also read a recent article by AIS and A2II, Access to Insurance Initiative. They say that most insurance companies prioritize process innovation over market innovation, but it has its own causes. Number one, profitability pressure. Investing and engaging in an unknown territory is always risky, and then comes the return period is a bit longer and it's slow. I remember reading an article from Harvard Business Review which is termed as short-termism because of the various pressure from the stakeholders like the shareholders. They need immediate profits. And instead of long-term sustainable investments, everybody is looking to get their return this year. So there is a lot of pressure and another important element here is incentives. For those who are, innovating and working for inclusive insurance, especially, let's say, from the regulators itself, what is the incentive? You invest heavily on microinsurance, parametric insurance, which return, you can't see it at least in the 10, 15, 20 years time. So what incentive do you have? So lack of incentive is also another element that everybody is scrambling for this area. And the last one is, of course, comfort area or comfort area bias, comfort zone bias, we can say it. We know commercial insurance business, comfortable, we know it, motor, fire, property insurances. Those are unknown areas. And of course, digitalization has disrupted the insurance world. No industry has been disrupted like insurance. It is imminent, it's inevitable. Everyone is working for that. So I believe we are yet to work on that areas. Thank you.
Okay, thank you, Mr. Yared. The next question would be for Elias. This is not about your presentation, but as a lead, the principal officer in FSD Africa, you have the experience as far as innovation is concerned. Particularly, you are working in 8 countries, including Ethiopia. So my question is, can you share with us your perspective of the state of innovation in the traditional insurance market, including Ethiopia?
Right. Thanks a lot for that question. I want to take this question in 2 parts, right? The first part is, what is the issues that we have? Now, I did mention the 3A challenge: awareness, accessibility, and affordability. Now, those 3 elements can only be changed through innovation. Now, when we talk about affordability, if the insurance solutions are highly price like they are quite expensive. You have to use innovative ways in which you can reduce the administration costs and all that. The issues around access. There are some areas that cannot easily be reached by the incumbent insurance companies. Then we really need to think about what are some of the enablers that can enable us reach those particular people. Again, innovation becomes a very critical element. And lastly, I did mention an issue around awareness. How then do we create awareness? And innovation really will play a critical role in enabling awareness. Then if you look at the other side that I'll kind of bring in is what comes in with those 3A challenges. And this is how we kind of bring again the 3D solutions. So there are issues around decarbonization. We all are talking about climate change, and we really need to think about how innovation can enable us to reduce the risks that come out of climate change and start putting our money in natural capital, which will be a very big element in increasing African GDP within the 8 countries that we've kind of had an opportunity to talk about. The second thing is digitization, and we've been talking about the process digitization, the expansion of digitization that will kind of create a leeway and bring issues around supervisory technology, SupTech, and RegTech from the regulatory perspective to change the outlook of how then we are going to regulate and supervise the insurance industry, in the same time enabling the market to understand how then this regulation will ensure expansion. And thirdly is around decentralization. How then do we bring in the new technologies? AI will be a very critical element. So not only talking about embedded insurance solutions, but in the future we'll be talking about generative insurance solutions using generative AI to ensure that our customers can access these particular solutions. So those 2 elements from the 3A to 3D will kind of change the landscape, but all within that then the insurance regulators and also the regulatory authorities really need to think about critically how then they balance these 2 things. And regulatory sandbox becomes a very critical tool. Now, when we talk about regulatory sandbox, is how then do you ensure that the regulator kind of tests its future regulations? So when we talk about regulatory sandbox, is how by the regulator say, okay, fine, we don't have these regulations now, but we want to test these particular solutions on how they can be able to address the future challenges. So it's more of, let us test our regulations ahead of time and start building on those particular regulations and streamline the market for the benefit of the citizens of a particular country. Thank you.
In fact, we have, the last question is about regulatory sandbox. Anyways, the next question is for Lynette and also Eduardo. It's about, under the current situation, do you believe that the regulatory mandate should be evolutionized? If yes, what has to be done? Any one of you who is comfortable to do it, you can take the floor.
I think I'll follow on from where Elias left it at, because he has broken it down very well up to the enabling environment space, where, as he said, and someone else on the panel said earlier, innovation is accelerating faster than regulation, and regulation has to sort of play catch up. Now, just picking up from the sandbox situation where you're incubating and you're testing these products before they go to market, I think regulators should go just beyond the enabling of innovation out of the accelerator or out of the innovation hub into the market, and to eventually serve those who need the product. But what has happened is we are having so many innovative startups come up, but then we don't get to see them. Only a few of them get traction or access to markets. So maybe that is an area that the regulators should watch keenly to pick up some of the best and see them through, together with the private sector, of course, working very closely with the private sector and government to make sure that those innovative solutions see the light of day and impact positively the lives of those who need these solutions. Thank you.
Thank you.
Yes, I think we've seen different models of regulation working differently in different countries. And I think some of the general principles that I think will be important to think as we want to evolve, because with digitization, we'll need to evolve regulation at the same time. There's no doubt about it. Now, what are the key principles? One that we have been talking about in the financial sector more broadly, the principle of proportionality. I think we've heard about it many times. It applies here as well. We need to adjust the regulation and the supervision of, to the level of risk that are posed to the particular products, to the segments. So I mean, that principle is something that as something that we should always keep in mind. I think there are other aspects as well, though. One is definitely we will need to focus more on channel flexibility. Channel flexibility when it comes to using digital platforms. That is how we see many other markets. They are opening new opportunities. They're achieving higher levels of penetration because of that. But even before you get to a full-blown digitization, let's say via e-commerce platforms, via apps, non-digital channels may also involve cooperatives, may also involve savings groups, or like those more local types of institutions that play an important role. We should not think about replacing them, but more complement the role that they already play. I think something that's important for us to think about is focus on outcomes. We need to focus on, and that's a really difficult aspect, especially when it comes to microinsurance, monitoring, getting appropriate data on, for example, on claims, on complaints, on usage levels. I know that getting that data, because often microinsurance companies tend to be small, and because the capacity to create data sharing templates is not yet mature, I think that that's an area that definitely requires more work. Lastly, as mentioned earlier, I would say consumer protection needs to be at the core. I've been talking about trust a lot. We need to focus on clarity around claims. We need to focus on simplified redress mechanisms and simplified disclosure as well. I think those are key elements that I think will be core to future regulatory efforts.
Okay, thank you, Eduardo. Yes, historically, supervisors' focus was prudential soundness, but now it moved from the prudential aspect to include market conduct, inclusive insurance, consumer outcomes, and proactive development of the insurance sector. So I thank you very much. I will also ask for your excuse for being harsh a little bit on you. And now I'll open the floor for 2 questions. We don't need further explanation and presentation, questions only.
Elu, I'm so sorry to interrupt. Unfortunately, we are out of time.
Really?
I'm told. We are out of time, correct? We are completely out of time, so we have to wind up at this moment.
Thank you.
Please give them a round of applause. And I'm very sorry we couldn't take questions from the audience. We really are running very behind. Sorry also, Elias, it was miscommunicated. Your presentation was not clear to me. Can we have a photo, please, of the panel with the moderator? Thank you very much, photographers. You're doing a great job. And we're going to move on to our next subject of discussion. Thank you very much. I'd like us to now move on to the panel discussion. I'll wait for our speakers to exit the stage as we invite the next panel discussion and discussants to take their places. We're now going to be talking about interest-free banking developments. Interest-free banking developments, and I would like to invite the moderator, panelists, and presenter for this session. The moderator is Mr. Mukemmil Bedru Sabir, the managing partner of Elegance Group. If you could come to the stage. Audience, please help me in welcoming them as they come up. Malika Bedri Mohammed, the CEO of Zamzam Bank. I've seen your stand out there, very colorful. Mohammed Zubair, CEO of Al Huda Center of Islamic Banking Economics from the United Arab Emirates. Please come to the stage. Fraser Ayalu, who we've had on one of the previous panels, the Director, Bank Supervision Director for the National Bank. If you could please join the speakers on stage. And Mesfin Bezu Yimam, who is the Chief Interest-Free Banking Officer at Dashen Bank. The presenter of this discussion is Mr. Peter Casey, consultant at the Islamic Financial Services Board. Thank you very much, Mr. Casey. Please, I'm sure you've been asked to try to limit your presentation to much shorter than what was planned. Thank you very much.
As our host has just told us, we are running very late, and I've been asked to cut my presentation significantly. But I will say a word about the title. First, I've used the term Sharia-compliant finance. And I do this deliberately because I want to signal that we're talking about more than interest-free banking. There are other sectors of finance. We've heard about insurance, for example. And also that Sharia compliance means a bit more than just not charging interest. And we may touch on some of those things as we go on. Hence my title. Now, I had originally agreed that I would give a brief introduction to Sharia-compliant finance for anyone unfamiliar with it. I don't have the time. And if this clicker would work, I would simply allow you to read what I would have talked about, move on very, very quickly. I will, however, pause here for a moment to draw your attention to a few things about Sharia-compliant finance, here with the focus on banking. First of all, where is it? Well, it's dominated by the GCC, but with substantial activities in the rest of the Middle East and North Africa, and also in East Asia and the Pacific. Those figures probably understate what's going on in the Middle East outside the GCC, because reliable figures for Iran in particular are very hard to come by. You will see also in the yellow dots the growth rates over in this case up to in the year ending in 2023. The thing that's clear from that is that overall, Sharia-compliant finance has been growing substantially faster than conventional finance, and that would be true if I looked at the years of this century as a whole. So growth rates, though they've changed over time, have still been fast. I now turn to the main meat of my talk, which is about an ecosystem. And I'm choosing those words because I think it's not simply a matter of having some interest-free banks and allowing them to get on with it without thinking what surrounds them. And what I've got quoted here is in my view of a rough running order for a typical country. The first thing you will find when you try and set up a few interest-free banks is usually that there are some obstacles you didn't realize till you actually started. A common place to find them is tax. For example, a common thing that an interest-free bank does, if someone wants finance for a car, is to buy the car from the dealer, sell it on to the customer with a markup and deferred payment terms. In some places, you'll find that both transactions get sales tax charged on them. Two lots of sales tax really make a mess of the economics. And I can find examples elsewhere in stamp duties on documents, in contract structures, in the way that the payments by the customers, who might be businesses, are treated if they are deemed not to be interest payments, but to be payments of a markup. Those things commonly differ. Every country's tax system is different, and I certainly won't try and guess what the Ethiopian one is, but you usually fall over problems of that kind, and I come from a country which had to remove those problems by changing its tax law and producing a lot of tax guidance. Second, okay, things are coming up in random order. Secondly, Sharia governance. The key claim that is made is that the finance or individual products are in compliance with Sharia. What are the arrangements to ensure this? Now, we've already heard, and it's a great step, that the National Bank is establishing a Sharia advisory board. You will still probably need to work out what you require in individual banks, what you require perhaps for capital markets products later on, and how those two interact. But that is a key thing to have in place. You may find, some countries have found, that you need to develop Sharia scholarship. After all, the guys who deliver this are about as well trained as senior financial services lawyers. And just as you wouldn't ask a family lawyer to come and give you advice on a major financial deal, there are some places where, because Sharia-compliant finance is new, the scholars don't know a lot about it. They're very experienced in family Sharia, inheritance, but they may need training, and I've, again, met countries where that was the case. I will just take the next one, even if I begin to run out of time. If I go into international meetings and Islamic banks are there, the thing that they complain about most often, let's go back, is the lack of liquidity management tools. And this is really a very big deal for them. First, what do you do if you're an interest-free bank and you've got some spare cash that you need to park? Well, if you were a conventional bank, you would now, in Ethiopia, have an interbank money market. That is wonderful. But, unfortunately, it works by charging interest. You're an interest-free bank, you can't do that. Okay, well, perhaps you could buy a T-bill. Hang on, the T-bill pays interest. You can't do that. Of course, there are other things you can do. Of course, you can buy equities, you can buy gold bars. But typically, finding things to do with spare liquidity is difficult. Finding things to do when you're short of liquidity is even more difficult. Do you have liquid assets you can sell? Can you get money in the interbank market? No, rather similar issues arise. In some places, the central bank may have a discount window overnight. But even if it does, it's almost certainly based on interest. So building the liquidity management tools is probably a key issue. I will say very briefly, financial safety nets, depositor protection has some issues in what it covers and how. In particular, are the profit-sharing investment accounts that are the most typical investor product for Islamic banks covered by depositor insurance or not? There are some other issues about building a properly Sharia-compliant deposit insurance system, but I don't have time for them. Lender of last resort, how does that work? Does that work with interest? It's possible. And of course, in the longer term, what you want to have is ideally Sharia compliant insurance. By the way, the banks would like that too, because if they are holding assets as part of their transactions, they typically want to insure them. You would like to have Sharia compliant capital markets instruments. Sukuk are the most obvious. You'd like there to be Sharia compliant money market funds. But that does require more of the infrastructure in place. At this point, you're probably getting terrified, and let me make the next points quickly, again, if this system works. The good news is it doesn't all have to be in place on day one. There are ways around most obstacles. Sharia recognizes principles of public good and even more, principles of necessity that will allow you to get round some of the difficulties as you build the system. You can build the system as the industry grows. But I want to leave the middle thought to last. That is, I think you do need to preserve a real difference. It will be very, very easy to force Sharia compliant finance into exactly the same mold as its conventional counterpart. If you do that, probably it will start behaving very similarly, because after all, your regulatory system will give incentives to banks to behave in certain ways. If it does behave too similarly, it will be open to the charge, which I've heard in other places and from Muslim bankers, among others, it's just conventional finance with smoke and mirrors. If it gets that reputation, well, what are you doing it for? I hope you are looking for a higher level of principle for those you are trying to serve. And that will require very careful thought. Thank you. That's, I think, all I have time for.
Thank you, Mr. Peter. First of all, I just want to say welcome to this panel discussion, which is, I could say, a unique, because we're going to talk about interest-free banking. And then I just want to thank National Bank of Ethiopia for organizing such a colorful and diverse forum. And also, I'm proud that they have included IFB as part of the sessions. Now, directly, I will introduce briefly our panelists, Mr. Mohammed Zubair, Director and Managing Director of Al Huda Center for Islamic Finance and Economics, Malika, CEO Zamzam Bank, Ato Fraser Ayaleo, Supervision Directorate, National Bank of Ethiopia, and Mr. Mesfin, Chief IFB Dashan Bank. So I will not take, because time is against us, I could say. We are allotted half of the original 1 hour. We have to complete this in 30 minutes. I will directly jump to the questions. So I just want to start from Mr. Mohammed Zubair. I want us to take us through the global practice of interest-free banking. What do the performance of interest-free banking players looks like in the global arena? And also, if you share us some trends that are happening currently and what we learn from those performance indicators and trends from the global perspective. I'm going to give you 3 minutes, please.
Okay. Thank you very much. I would like to thank to NBE to give me this opportunity to part of this eminent panel. If we see the global development of interest-free banking and finance, currently the total size of interest-free banking and finance is around $4.4 trillion. And interest-free banking and finance is being practiced in about 120 countries. And more than 600 Islamic banks, along with about 500 takaful companies and more than 1 2,000 Sukuk and Islamic funds are working all over the world. We can segregate interest-free banking and finance into different components. By the way, in this beautiful country, interest-free banking and finance is being pronounced for Islamic banking. But for example, in UAE, we called it Islamic banking. Malaysia, Pakistan, and many other countries. But many other countries, they have different names for Islamic banking. For example, in Nigeria, interest-free banking is called non-interest banking. In Turkey, that is called participatory banking. In Cameroon, that is called specialized banking. In Europe, sometimes that is called ethical banking. But whatever is the name of interest-free banking and finance, whatever is the underlying principle, that is the same. So we can segregate interest-free banking and finance into 7-8 components. One of the major components is interest-free banking. About 70% total volume of total interest-free finance belong to the Islam interest-free banking. The second major component is Sukuk. About 20% total volume of interest-free finance, which is $4.4 trillion right now, belong to the Sukuk. And I believe that in this beautiful country, you will have Sukuk very soon as well. And the third component for interest-free banking and finance is the Kafir, which is already in your country. Then Islamic microfinance, then Islamic fintech, Islamic indices, Islamic stock market, Islamic capital market, and etc. Geographically, what is the performance and what is their share? The major share belong to the Asian market, in Far East Asia, like country Malaysia, Indonesia, in Middle East. These are the major markets for interest-free banking and finance. The second largest share by continent belong to the Africa. In Africa, we can segregate interest-free banking market into 4 major regions. The Western region, which have a largest component right now, like country like Nigeria, Senegal, Ivory Coast, Mauritania, Burkina Faso, they have a good Islamic banking structure over there. After that is East Africa. In East Africa, the major market for interest-free banking and finance is the Ethiopia, Tanzania, Kenya, Somalia, Somaliland, Djibouti. But I would like to add that in East Africa, Ethiopia have unique position. If you see the piece of interest-free banking in Ethiopia, that is much better than to Kenya, Tanzania, and other regional market. Because if you see in Kenya, they started Islamic banking about 25 years back. But whatever share you have in Ethiopian market, that is much better to other regional market. And I believe that Ethiopia have a prospect to be the regional hub for interest-free banking market. And as I heard in the morning that now, according to the current policy of NBE, you are also inviting international bank, foreign bank in Ethiopia, then I believe that you will have a lot of good foreign direct investment in interest-free banking from Middle East and some other country in this country, because the response of interest-free banking over here is very good. And at the end, I also want to add one thing, that interest-free banking is not a religion. This is a system which can be utilized or operated by Muslims and non-Muslims. But for Muslims, yes, they have an extra advantage that it is according to their religious beliefs. But for non-Muslim brother or sister, that is a very good system for banking and finance. If any non-Muslim may utilize interest-free banking product, it will not affect to their religion, because that is the system. For example, I am a Muslim. I am utilizing Samsung phone, and in this Samsung phone, I am utilizing Android operating system, which is made by non-Muslim. And in a day, I have to utilize that system about 100 times, WhatsApp, emails, message, call. I am the Muslim, I am utilizing a non-Muslim operating system. Either that affect to my religion? No. I am just operator of the system. Similarly, in this beautiful country, if interest-free banking and finance will be open for all, then I believe that whatever is the benefit of interest-free banking and finance will be equally utilized in this beautiful country. Thank you.
Thank you, Mr. Mohammed. Probably throughout the day, if asked what was the most frequently mentioned word, it could be among these three: inclusion, accessibility, financial inclusion, accessibility, and I think the other one could be diversification. So these three words are, as per my understanding, have a direct relationship with the interest-free banking product offerings. Now I will take you to Malika, who is the CEO of the first full-fledged interest-free banking, Zamzam Bank. And I just want you to take us through the performance of the interest-free banking operators in general in Ethiopian context. And I just want you to address also, are they living up to the expectation? There was a long expectation for the interest-free products and services. So tell us about the performance, and also, are they serving the expectation?
Thank you, Mukambil. Good afternoon, everyone. I think it will be hard to address such difficult questions. It seems everybody is tired, but I want to create some emotional attachment while I'm responding to this question. When you are asking me whether it is performing up to the expectation, I think I need to state the critical milestones before directly answering your question. Otherwise, the issue might be misleading if we only focus on the numbers. To mention the milestones, the history of may I use the word Peter used, the Sharia-compliant banking, the demand in our country's case, it came from the public. It dates back to 2008, some 17 years back. And at that time, during the formation of the first Zamzam Bank, though it was not successful, the effort, pushed the then authorities to include an article in the proclamation number of 592, 2008. This is the beginning of the history, which we mostly forget when we, discuss about the history and the development of interest-free banking. Later, after 3 years of ups and downs, the directive, which we all know, which is SBB 51/2011, was issued and allowed the operation of window service instead of, the question which the public was fighting or pushing for. This was another critical milestone which we also to put on record. On this important event, while we are launching the first inaugural of the financial sector, I would like to, celebrate the National Bank of Ethiopia for organizing this event. And on my part also, I would like to ask the audience to join me in acknowledging the visionaries who pioneered the idea of interest-free banking at those difficult times. After that also, one thing I would like to acknowledge as milestone is the commercial banks which were in operation at that time, who started the window service from scratch and who introduced that to the public and also familiarized the product. We can cite Oromia International Bank and banks like Commercial Bank of Ethiopia. I want also to acknowledge these milestones. So the other milestone which brought, big transformation in this field of business is the enactment of SBB 7229, which the government, as a part of its reform program during the inception of the office, which it allowed the operation of full-fledged interest-free banking. Again, please allow me to acknowledge this milestone because this has created a shift in the financial sector. The financial sector, which was dominantly conventional, was turned to dual system because of this transformative and bold policy decision. It is not about directive, it is a policy measure which is part of the transformation that we can consider it. After that, enactment, the full-fledged interest-free banks, starting from Zamzam, other three full-fledged interest-free banks, apart from the window and the standalone branches and banks that we are offering, joined the market. To name them, we are very few, Hijra and Shabele and Ramis, the full-fledged interest-free banks can be mentioned. So all these achievements, I think we have to tie it with the big shift which is brought as an enactment of that proclamation and directive. And I will try to compare the figures before 2020, the year 2020 and the year 2025. If we look at the deposit volumes before the enactment of this directive, the volume of the deposit, which was very, progressive for that time, was 57.7 billion. But now, after 5 years, with the figure as of now, it stands at 330 billion in March 2025. Apart from the numbers, which this fact shows, the trust and confidence the customers and the public started, started to put in the system and in the interest-free banking as a whole, because the confidence is set at the top, and the people and which were somehow reluctant to the service started joining the market. This number holds like 10% of the whole deposit volume of the financial sector. If we look at the growth trend also, it's the growth rate annually is 30%, which is more higher than the conventional one. Of course, as a growing market, we expect the growth, and this one is also can be considered as one testament with the growth of the business. If we look at the customer base also, the customer number, which was 5.6 million in the year 2020, has now grew to 25.8 million, as that data of the March 2025 shows. The unbanked population started using the formal financial service, particularly those who had been marginalized or excluded from the service sector because of religious belief or other factors, are now truly included in the system. Most importantly, this development has reversed the stereotype mentality which were circulating by questioning the sustainability and the profitability of the interest-free banking. The interest-free bank in general, be it window or otherwise, or the full-fledged interest-free banks in particular, started making profit within less than 3 years of their operation, and they sustained that profit as well. As Mr. Mohammed was saying, and as we heard from the presentation, apart from its contribution for inclusivity, the business itself is profitable and it has business case. Most importantly, the sector showed its inclusiveness. It has nothing to do with religion. Of course, the base is Sharia principle, but the service serves every walk of life. In our environment, if you see the full-fledged interest-free banks, we have shareholders who made equity investment in banks. We have customers who made their first choice the full-fledged interest-free bank and the window service. We have also employees and senior management members who stand for the cause, because it is all-inclusive business, and that has been also challenging practically. If we see the other element which shows the business growth of this model is the financing volume. The financing volume, which was only 13.3 million, 13.3 billion in the year 2020, has now surged to 151 billion. We have heard in the morning's presentation, the half part of even the numbers are increasing as we talk now, but 50% of this volume goes to the state-owned Commercial Bank of Ethiopia, but the private sector is also taking its lion's share. The important factor here is not about the number. The borrowing to deposit ratio is significantly increasing. When you look to the interest-free banks and the full-fledged ones, we don't have other business. Whatever we mobilize from the public goes directly in the form of financing. So the ratio is improving from time to time, from insignificant number, but especially the full-fledged ones are holding like 70% loan to deposit ratios. This has meaningful economic reasons. That's why I want to stress it. So I don't want to take much time, but if you look on the profile of the borrowers, the first-time borrowers which has never accessed the banks we are proud of them. They're coming for the first time and they don't have any clue about financing. In one hand, we are teaching them. On another hand, also, we avail the service, and the volume is impressive when we look in this angle. Apart from the traditional financing, the IFB sector also introduced non-collateralized digital lending. The non-collateralized digital lending is especially the Sharia-compliant digital platform is addressing the finance need of the underserved micro and small and medium enterprises. A case in point which I would like to state in this point is the AI-powered digital platform Ansar that we have launched in partnership with the Kafia technology. With this very much data-driven technology, like we heard it repeatedly in the morning, this is also the first of its kind for the interest-free banking sector. In fact, it is not only the first for our country, it is also the first in Africa, and very recently it has brought to our country award in the international forum, in international stage, which the Ethiopia's name was highly mentioned. In this platform, from the traditional one, if I compare my own data, since our bank's formation, the numbers that we have financed is less than that figure. Within short period of time, we have managed to onboard more than 5,000, close to 6,000 micro and small borrowers. Majority of them are women. In this point also, I would like to acknowledge MasterCard Foundation for the credit de-risking effort that generously they provided us. In fact, the women and the youth and the small businesses are not risky one, but to start the business, they provided us the de-risking element for the Ethiopian banks, and for especially as a Zamzam is the only bank which included as full-fledged interest-free bank. I had to acknowledge on behalf of everybody. In conclusion, what I would like to underline is innovation, digital financing, partnering with fintech companies, and onboarding every stakeholder is very essential to grow this market, as we have heard it from experts. Its potential is immense. Its contribution is not only for profit, it is for economic growth and for real inclusiveness. I'm sorry if I took much time.
Thank you, Malika. You know, I was looking at my watch, and how could I stop Malika? Someone who brought a commendable bank from nothing into something. Thank you, Malika. So I will move to Mesfin, and then I will come back to Mr. Fraser. There is this, I don't know if it is a misunderstanding or you can quote it in any way, but we call it here interest-free banking. Is there a free lunch? This is the most frequent question which I receive from individuals. How do a bank survive as providing, I mean, you can call it equivalently loan without any charge, without any interest? So keeping that point into your mind, what are the product offerings of interest-free banking? Particularly, I want you to focus on those products that have addressed the issue of, finance access and so on, compared to those products which we find in the conventional scheme.
Thank you very much, Mukamil. It's a very important question that we should address. I will try to address is within the limited time that you gave us. Yes, interest-free banking, or as we call it differently in various jurisdictions, and as Peter has said, I love the idea of naming it, and I think National Bank of Ethiopia is also adopting it. A Sharia-compliant finance is a good name. After all, it's a business. It's a business that's after profits. The only difference it has from the conventional part is it has its own additional layers of principles that it should adhere, especially given the Sharia foundations that gives its ethical and jurisprudential foundations. That adds to the conventional business, I cannot say entirely new, but additional requirement in terms of fairness, transparency, and justice. So it's a business model. We are after profits. Before I address to the specific question with regards to Ethiopian banking, with regards to product portfolio and diversification, I think we should look at the global context, because Ethiopia's interest-free banking has been here for more than 10 years. And if you cannot compare it with the global practice and current status, we cannot appreciate how far we have come, despite all the challenges that we have, be it at the regulator or industry side. Globally, the interest-free banking or Islamic banking industry, in terms of product diversification, has shown tremendous, growth and growth in terms of both product types, asset side and liability side as well. So originally, especially on the asset side, Murabaha was dominating it, largely, as is the case in Ethiopia. 60 to 70% of the global portfolio falls under Murabaha, that is cost plus markup financing. But they have moved to other models like equity-based model, lease model, and others. And they have created so many digital platforms so that they cater to the wider population. In terms of the liability side, initially it was cost-free loan, deposits like Ard, Wadia, but they have also expanded to profit-sharing investment and deposit accounts like Mudarawa, Wakala, and other type of products. When it comes to the Ethiopian context, much is not different from the initial stage of the global phenomenon. Currently, if you take the asset sides, yes, Muraba dominates largely, more than 90% of the product portfolio lies on Muraba. This is not unique to Ethiopian sector, because Muraba is very much simple for conventional bankers, easy to adopt, easy to educate customers, and easy for implementation. It aligns with so many legal requirements of countries. So Muraba dominates, but banks are trying to expand it, and we also give Kardalasan and Ijara, but I think there is no attempt to diversify it into equity-based products. On the liability side, still the Wadia and card cost-free deposits dominate the market. Mudaraba, I can confidently say that it is lower than 3% of the total 230 billion birr deposits that so far banks at conventional windows and full-fledged banks have so far mobilized. So the question comes, I think Fraser can add on that, the National Bank of Ethiopia has not put any restriction on product offering. It had made it clear to all banks that there is no limitation. So the question comes, why are not banks able to roll out all these products that we know that are on the shelf in other parts of the world? I want to also commend the National Bank of Ethiopia for the effort to take precautionary measure and expand it through time to make enabling environment level playing ground for Islamic banks and other financial institutions to play in this sector. But I must also admit that other ministerial institutions have not followed suit. The National Bank of Ethiopia have given us the floor to play, but still others should follow suit, because banks, yes, they have limitations. I will come, if I have time, later on why they failed to roll out so many products. But there is no restriction from the NDB side, but institutions like the Ministry of Finance, Revenue, and others, ministerial officers should follow suit to create enabling ground, because the experience that we learn from other countries is that this product diversification has expanded significantly because of enabling environment and the market demand, and as well as institutional capacity of individual institutions. So what are the constraints? It's obvious. There is no restriction from the NDB side, but we as a player should sit together with NDB, the tax authority, and other relevant bodies to sit together and create enabling environment. When I come to specific developments, yes, there are so many banks here in Ethiopia that have tried to roll out digital products that have been mentioned earlier and try to cater to the wider public, right? So, going forward, yes, we have the very important question you have asked to my colleague Malika. This is my personal opinion. As a bank, we have, as a country, we have done a very good job, because this 25 million accounts, 230 billion deposit, more than 150 billion in financing is not something that, easy to, achieve, but still there is a lot to be done, by all stakeholders to diversify our product portfolio and unlock the potential of interest-free banking in Ethiopia. We have heard good news from our colleague, from the National Bank of Ethiopia, Mr. Fraser, that a set of regulations will be rolled out in the near future, but I still maintain my previous statement that others should follow suit, and I think National Bank of Ethiopia will take the leading role in this regard. Thank you very much.
Thank you, Masfane. This will be the last question for the interest of time, and I will forward it to Mr. Fraser. So, what are the main or the major reforms that are happening right now, which will affect the interest-free banks? And what recommendations do you have about their preparation or actions they should take from the outset so that they can cope up and perform accordingly?
Thank you, Mukammil. I think since Wazir Malika has went through all the legal and regulatory evolution with regard to interest-free banking and the performance of interest-free banking, I will not touch on that. But one thing I can say is, in Ethiopia, interest-free banking has, gained lots of, traction in terms of, particularly mobilizing deposits, from the system. So it was long ago that, this sector has attracted and accounted, 10% of the total deposit of the banking system. So this has achieved long ago. So we are on that momentum. So the only thing that is being, discussed or, pointed out as an issue is on the financing side. And for me, it's quite, organic and natural that, this is happening. But going forward, I do believe that, the industry has to perform more when it comes to product diversification and also leveraging of technology in terms of availing the service to the final consumer. So that's what I can say with regard to the legal and regulatory reforms. So similar to what we have been doing on the conventional banking side, we are also reforming the legal and regulatory framework for the interest-free banking. So if you see the recently enacted Banking Business Proclamation, we have included quite critical legal provisions that would help for the further development of interest-free banking business in Ethiopia. So that includes from the very basic conceptual definition of interest-free banking service and who are like the players. So we have made it explicit in a sense that interest-free banking business is a business that is delivered by both full-fledged bankers and as well as also conventional bankers through window approach. So we wanted to be clear on that front. And on the definition of even banking business, we have also included a provision saying that interest-free banking business is a banking business. So the only difference is the mechanics and the modality of providing it. So it is part and parcel of the banking business, but there are some as much as there are so many commonalities and similarities, there are also differences. So our approach is to recognize both. So if there are commonalities and similarities, it means that this will pose the same risk, then the same regulation should happen. And on areas where we are seeing differences, peculiarities, then we need to come up with like customized and tailored legal framework that will suit to the interest-free banking business. And one development or provisions that we have included is the need for having a very comprehensive and robust Sharia governance framework, because this is quite critical even for regulator, because it has direct financial system stability implication. Unless you are managing this risk well, then it will pose a question of public trust and confidence, and that will further escalate into stability. So for that reason, the central bank will come up with various legal and regulatory instruments that will address this risk, be it in the form of compliance, Sharia audit, and Sharia committee, and all those will be addressed going forward. And just to sum up, I think we have well progressed so far within such a relatively short period of time, but there are challenges here and there, and as has been said by other panelists, so there is no similar level of understanding with different actors, including within the government apparatus and others. So I think in order to address this issue, we need to come up with a kind of national policy framework for addressing Sharia compliant financial service. So this policy framework will bring all government and other stakeholders together, and then they can support and provide what they are expected to do for the further development and advancement of this sector, with a view of creating a more inclusive financial system, and for the purpose of contributing and getting what this sector needs to contribute for the overall economic development of the nation. Thank you.
Thank you, Mr. Fraser. Finally, just if I have to sum up today's discussion, IFB is becoming a serious business. It has gone a long way in the past 1 decade, from nothing to more than 10% of the total industry size. And the other point is IFB is not only for a specific segment of society, be it, for example, in terms of religion, for a specific religion. It is a competing and alternative business in the finance industry, so we have to take this message as it is. I just want to thank all the panelists. Thank you. That's all.
Thank you very much. Thank you to all the panelists who joined us to discuss interest-free banking development. Appreciate your time. Sorry for curtailing the session slightly. The obligatory photo, right over here. Photographers, please help me to take this photo efficiently as we head towards the end of day 1 of the day. following this session, we will be inviting you all to the terrace at the back for tea, coffee, and some light snacks. But before we get to that moment, I want to now thank you for applauding those speakers. I want to now ask our final group of speakers to join me here on stage for a fireside chat on financial sector development and prospects. This is the closing session for today. Stay with us. It is going to be exciting because the moderator, Marlon Rollins, is so good. Marlon, if you could please come up here. Marlon Rollins, Senior Financial Sector Specialist for the World Bank, speaking to Mr. Aliu Maiga, Regional Industry Director for Financial Institutions Group Africa. If we could applaud Mr. Miaga as he joins us on stage, and Mr. Al-Walid Al-Latabani, Practice Manager at the World Bank. So, Marlon, you can seat your speakers for this final fireside chat of day one of the Ethiopia Finance Forum. Over to you, Marlon.
Thank you so much, Yvonne. So I have the unenviable task of leading the final session for the day for two reasons. One, I get to moderate a panel with my boss, my manager, and my IFC director. So in the organization, we talk quite fondly about managing up, but I feel as if I'm moderating up today. So I guess if the session goes well, my performance review should be good. If it doesn't, then it means I'll be moderating exit interviews out of the World Bank Group. Ladies and gentlemen, can you please give yourself a round of applause? Thank you so much for staying the course. I think the fact that you're still here with us and we still have at least a packed room is an indication of how important the financial sector development is here in Ethiopia. So I want to jump right into it. I know I have very little time, but the good thing about it is quite a bit has been said today. So this panel will really try to bring together all of the ideas that have been discussed, all of the new ideas, and then seek to chart a way forward. So on my right, we have Al-Walid, who had my job back in 2008. So he has quite a bit of history working on Ethiopia. So Walid, I just want to jump right in and just to get your views. Having worked here on the financial sector in 2008 to 2011, and coming back 2 years ago as the manager for Eastern and Southern Africa, what is your view on the pace and speed of financial sector development here in Ethiopia?
Okay, thank you so much, Marlon, and it's actually a pleasure to be here. And, you know, I took on this role in 2022, July. And one of the things that surprised me when we first came on board, Marlon actually joined the unit around the same time, and, you know, he landed in Ethiopia and he was very optimistic. And based on my previous experience from back in the day, I told him, you know what, Marlon, calm down. I don't think anything is going to move in Ethiopia. And at that time, my brother Aliya was also country manager for IFC in Ethiopia. So we had very high aspirations, and, you know, after many days of blood, sweat, and tears, I mean, actually, not much had moved. And, you know, fast forward 15 years later, and it's dramatic, the change. I mean, I have to be honest. I think, you know, the credit does go to this cadre of leadership that we have today in the economic sectors in Ethiopia. You know, with very bold reforms, you know, they demonstrated the seriousness of their intent. And I think that this has shown across on the macro sector, but also on the financial sector, which is where we specialize in. And we've seen, I mean, you know, looking at, you know, the whole legal architecture for the banking system in Ethiopia was so outdated. And, you know, to bring it to the 21st century, I mean, it took a lot. But, you know, NBE was very keen to see this evolve, whether it's in the NBE Establishment Proclamation or whether it was in the Banking Business Proclamation, opening up the sector and really trying to transform the financial system in Ethiopia. Now, I mean, it's clear to me, listening today from Governor Mamo, listening today from Minister Ayub, you know, there is an understanding that, you know, we need to break away from the past. It cannot be business as usual. We have to think about the financial sector as an enabler. An enabler for what? An enabler for growth. We have to think about how do we fund or finance, you know, SMEs, exporters. And all of this is a means to an end, and that end is essentially to generate growth and jobs. And I think that this is very crystal clear in the conversations that when we have with the senior leadership of Ethiopia, this comes out very, very clear. And I think, you know, to Marlon's credit as well, I mean, on this project on FSSP, you know, enormous amount of work that was done on our side as well as on those of NBE, CBE, and DBE that brought this to fruition. So I just want to congratulate everybody involved on this project. But I mean, to answer Marlon's question, I mean, this is just night and day between what we had back then, 2008, 2011, when I first started here working on Ethiopia, and where we are today.
Thank you so much, Waleed. Ali, over to you in terms of a similar question. So Ali, you started the IFC's office back in 2008, I think, opened the first IFC office here in Ethiopia. What are your impressions many years later?
Thank you very much, Marlon, and thank you, Governor Mamo, for this fantastic event. As always, you are beating expectations in many ways. Let me just start by saying that, you know, as a World Bank Group, I think we talk a lot about financing, finance, and investment and co. But ultimately, what we are trying to achieve is development, and that's really about improving people's life, you know, through job creation, through income, and so forth. So, and that's why I always look at Ethiopia differently, because I know when I was coming here, I was told, you know, you have to do 200 million investment per year. I did maybe 10 in 2 years, but I was very happy because what we focused on was more governance and capacity in the financial sector, for example, and across the economy. And what made Ethiopia unique was that there was a very deliberate emphasis to build a foundation for development before opening up, you know, certain key sectors. So it was deliberate. So it's not something that was not planned. And therefore, if you want to assess the development of Ethiopia, you look at the growth. I think it's the only country in Africa that has been growing between 8 to 10% for the past 20 years, okay? And it's also, you know, one of the, you know, parameters that I use always is when I moved here in 2008, the capacity installed in the power sector was 400 megawatt. I just checked today, it's a 5.4 gigawatt. They build roads, they build, you know, they lay down fiber optics, they build, you know, industrial zones. And those are things that really are critical for development. And we are at a phase now where they realize and they decided to change the focus of the financial sector from, you know, from financing those aspects of, you know, foundation and development toward financing private sector more and economic growth. So that's the way I would look at it. And if you ask me the prospect, I would say with the foundation they have today, and just also what I see across the banking sector, because I've been working here for the past 20 years, I can see how bankers have become more, you know, sophisticated, more confident, and more innovative, and I think the future is very bright.
Thank you so much, Ali. Hang on to the mic, just a follow-up question for you. There's a lot of talk about mobilizing the private sector and making sure we can maximize the synergies between public sector and private sector. Of course, IFC is very deep in that particular area. Can you just share a few insights on what are some of the things the government of Ethiopia should be doing, in particular on the financial sector, to really engender that spirit of public-private partnership?
Look, I think they are doing a lot of things that they ought to be doing, right? Because the major reforms that they did in the past 2 years, are very, very critical and very important for the future. And it's not only economic reforms and monetary reforms, it's also banking sector reforms. And we have been involved, World Bank and IFC has been involved in some of those. I can tell you, for example, our team here has grown significantly, and we have a major senior people here now. Our head of, our most senior person in capital market in Africa is based here. Our most senior person in housing is based here. So I hope that, we'll do a lot. Right? So to me, it's not about what Ethiopia has to do, it's more how we, World Bank and IFC, can pull our resources together to put it behind the development of the country. I'll stop there. Yeah.
Excellent point. Partnership compact. Walida, I'll come to you on a similar question. What are some of the things? So, a lot of the discussions today have centered around focusing on building the rubric, getting the financial stability right, getting the framework in place. But at some point, we have to pivot now to mobilizing capital, getting job creation, making sure that the private sector has access to finance and so forth. Can you share a couple of insights on what are some of the things that we could be doing, and in particular, how the World Bank Group can support the government of Ethiopia in that path?
Yeah, thank you, Marlon. I mean, we have to recognize that the banking sector and financial sector reforms are not taking place in a vacuum. They are taking place in the context of a broader macroeconomic strategy, including one of the major binding constraints that really held back businesses in the past, which was essentially the exchange rate. Now with, the liberalization or the reform of the exchange rate mechanism, what this is doing is that it's addressing one of the key binding constraints for importers that can import intermediate goods, that can use, to develop their exports and to continue to grow their businesses. And I think, with that, I mean, obviously, a lot more needs to be done in terms of reforming the business environment. A lot more needs to be done in terms of capacity building, digitization. It came out a lot during the conversations today. And all of these are strands of work that need to continue. And we also need to recognize is that things evolve. I mean, we cannot just rest on laurels and say, okay, we've done the heavy lift, but we still need to do so much more. This includes, bringing more innovation to the world of banking, bringing more innovation to what the private sector does, but also bringing more innovation and technology use on the side of the government. So I think that this is still a journey that needs to be undertaken, but I think we are taking the first few steps in the right direction to help us achieve those objectives.
Absolutely. Aliyu, on the 10th of January, as you're aware, Ethiopia made the bold step and launched capital markets. And this, of course, will support access to longer-term finance. And in the two of the previous sessions, there was a lot of discussion around housing finance, agri-finance. How do we support SME access to finance? In your view, how do you think the capital markets can support access to infrastructure and financing for infrastructure and so forth?
I think the capital market, I think the first function I would say today is really to bring into maybe a more formal environment, things that used to happen like in the background. In many ways, I think going back 20 years ago, there has always been a vibrant exchange of securities in the background. It's just over the counter. So the stock exchange bring it in a formal setting. And also, I think to have the monetary reform that are needed to support the economy and the country, you need that capital market infrastructure to issue bonds, including government bonds, and to trade bonds, and to provide liquidity in the market. So that's the first function. I think as it develops, it will also provide financing for infrastructure and co. I would say, just to speak very broadly, like I said, World Bank and IFC, we have a lot of resources and both financial and expertise together. And I think we are in a country where there is a lot of planning and thinking ahead. And I think that gives us opportunity to really work together to build something for the future. You ask how can we help, the development of the private sector and co. I would say very broadly, given what's happening in the world today, okay, and I have to say honestly, it is one of the most tense, periods that you can find in terms of geopolitics, wars and so forth, and also the rapid succession of crises, okay, in the past, decade, and then the changing attitude toward AIDS means that Africa needs to become self-reliant. It doesn't mean it has to be closed. It just needs to be more self-reliant, meaning that whatever we can do ourselves, we should do it. So, very broadly speaking, I would say our role as a World Bank Group in the financial sector is to support the financial sector to build the capacity, the capital, and the expertise so that it can finance the economy from domestic resources. And then I think we can really, benefit all of us.
Excellent. Walid, if you could add some thoughts around the role of the capital markets to support longer-term access to finance, building depth, and possibly if you could share an experience either from working in East Asia or so that we could learn from. Thanks.
Yeah, I mean, I think, the best way to describe this is really look at my experience in Vietnam. I spent 5 years in Vietnam, and we had a very similar situation where you had the interconnectedness between the SOE sector as well as the state-owned banking sector. And one of the things that we started to work with them is on the project on banking sector soundness and development. But in parallel, we were working on developing the corporate bond market, the domestic corporate bond market. Why? Because one of the key risks that we saw in the banking system was a heavy reliance on bank lending to the SOEs. And we felt that if we can get these SOEs in better financial shape, they could actually issue corporate bonds in the domestic market. And we did have one case, EVN, which is an electricity company in Vietnam, which ended up issuing a bond in the corporate bond market, and domestic corporate bond market in Vietnam. And I think that this is the direction where we have to start moving into in the case of Ethiopia. We have to look at the capital markets and the development of the capital markets as an opportunity to help us not only raise funding for the SOEs, but also to diversify away and reduce the risks in the banking system as well.
Thank you so much, Walid. Just to pivot a bit to the whole question of financial inclusion, greater access to finance, how do we help to support the engine of growth of the Ethiopian economy, that is the SMEs? What are some of the opportunities, based on your past experience, that we should be focusing on really to make sure that the financial sector is able to provide for the SME sector in a way that supports, of course, growth and job creations? Any thoughts?
So I think Ali would be better placed to answer this question, but I'll just make a couple of remarks. SMEs are very unique. Most lending in our countries are collateral based. SMEs oftentimes do not have collateral. You have to think about alternative products, financial products that they can tap into, factoring, reverse factoring alternatives that can help them with their cash flows. And I think that what we will begin to see now that we have addressed the stability risks in the banking system, that the banks themselves will begin to look at opportunities to innovate and to introduce new products. And at the same time, I think that the regulatory framework allows for such innovations to be introduced into the marketplace. And having said that, I think that, it's just a matter of time where you're going to see that, banks introducing these new products, but also trying to bring in, capacity into the banking system to be able to manage these products. So essentially, in terms of the perceptions of risk, I think that they will be very different going forward.
Thank you so much, Walid. Aliyu, I wanted to turn to you a bit, just to speak a bit about the opening up of the banking sector. So there has been a lot of talk about this. The law has been promulgated. NBE is in a position now to accept applications. What is your view? Having worked extensively with the private sector, what else beyond the law, what else can be done to make sure Ethiopia can attract the right set of banks into the sector as we open up?
Thanks a lot. I want to compliment on the previous question, SMEs and co. I think SMEs are the most generic terms of enterprise when you cannot reach a particular sector. And that's why we are also targeting agriculture. Because agriculture touches across the entire economy, from small-scale farming to micro to SMEs. But if you look at all of that, the challenge for banks is how do you have enough visibility to be comfortable to lend, right? And that visibility today can be breached by tech companies. And some of them are here. And I think the way to look at it is to think in terms of partnerships. You have tech companies who can actually digitize the entire economy if they have the resources, so that banks and policymakers have visibility in the economy, both in terms of sectors but also in terms of businesses. And then you can start really targeting them and serving them better. One of our partners here, Kifia, last year won an award, a global award in Brazil on SME lending. And we are very happy with that. And there are many of companies who can help as well. But the point is that the partnership between traditional banking, policymakers and DFIs, and then the tech companies can really unlock both SME and agri-lending. Your question, the last question, maybe what did you say?
About the opening up of the banking sector.
Yeah, opening up the banking sector. I spent time in Asia, So, when people talk about Ethiopia that is closed, has been closed for a long time, if you go to Asia, the first thing you notice is that it's actually very similar in terms of approach to sector opening, And I think it's a process. It's not something that happened overnight. I think, like the governor said, today, it was first important to have a stable macro environment, which is still playing out, right? Inflation went from 30 plus to 13. It's a very good level. It could still be improved. And then it takes time for banks in general, foreign banks in general, to get familiar with an environment and then come and invest. And by experience, I know it's even longer for Asian companies, banks, for example. But I think what is important is the signaling that Ethiopia is open, and then we know many banks across Africa who are interested, but the law is being passed or it just passed. There will be a learning process, and teething process. But ultimately, I think what is important is to attract the right partners. I met some banks discussing agriculture recently, and the whole perspective was how can we make money as foreign investors? And I keep telling them, honestly, I'm looking at this also differently. Has to complement each other. So it is in the interest of the country and also us to make sure that the partners we attract come here and make money, but also add value to the economy. And I think that process is what we need to focus on. And for that, we have a lot of experience. One of our panelists today, Bashar Samra, he's sitting here. He lived in China for, 20 years. We worked together in Asia. He was the chief risk officer at Bank of Beijing. We invested in, I think the first 7 investments in the banking sector in China were done by IFC. So, and then we approached, we help the banks on corporate governance, risk management, and co, until they attract partners, and those partners did not take control up front. They come in at 20, 40%, and then they gradually, evolve. So I think what is important is the opening, the signaling, and then we have to have a balance between national interests, our own interests and investors' interests, that works. Thanks.
I want to ask the question that Governor Mamo is thinking. Yeah. When will IFC invest?
He has been asking the question for the past year, And I'm going to pass the question to my colleague Gokan here.
So Gokan, you on the hot seat.
No. More seriously, we did a lot of progress in Ethiopia in the past 2 years. When I started my job, this time, we had 2 banks in our portfolio on trade finance only. I think with the signing of Wegagen last Tuesday, actually yesterday or the day before, we have 6 banks now in the portfolio. But it's all trade. And I can tell you why it was all trade, because we have internal parameters and and also there's a learning process. What I can say is that we are already preparing a package to invest in Ethiopian banks like we did in China, but we'll do it in a very careful manner that is in the best interest of everyone, but it is coming.
Okay. Fantastic. So Governor Mamo will hold IFC to that. Now, we're very acutely aware that we stand between you and the cocktail hour that Governor Mamo is paying for. So we're going to wrap up quickly, and we wanted to give, firstly, Waleed, just a 1.5 minute just to share any parting thoughts, any words of advice, any lessons learned as we close.
Okay, thank you, Marlon. Look, I think this is a journey. It doesn't stop with a DPO, it doesn't stop with an ECF, it doesn't stop with an FSSP. I think this is a continuum. We need to continue working together and trying to, put Ethiopia on a stronger path. The fundamentals are very strong for this economy. I think that the difficult decisions have been made, but I think that we need to continue to invest our time, effort, and sweat to make things right, to ensure that we are on a good path. The one thing that I would, if Governor Mamo asked me today, one thing you tell me, what do we have to start thinking about? The one thing I would tell him would be, we need to have a credit rating agency in Ethiopia. And the reason why is that with that you can begin to price risk according to the real risk. And I think that this should be the next steps going forward. So in terms of financial infrastructure, there's one area that I would say that we need to start thinking about going forward.
Thank you so much. Ali, over to you.
I would just say, conclude by saying that I may have been biased a little bit toward Ethiopia, but I think many people know that. But to me, like I said, a lot of effort has been made in the past 20 years in terms of infrastructure and and then in the past 2 years in terms of economic reforms and bank sector reforms. If you ask me, among countries that has the best potential, in my view, in Africa, Ethiopia is among the top 3. Okay, I don't want to rank them, but so that I don't create any incident. Why? Because I think they build the infrastructure for a long period of time. And then I think the education system, whatever people may think, is still okay, is still good. You have a very large trainable labor force, okay, that can be attract a lot of companies, particularly now that the global tariff war has started, and I don't think there is an end to it. Many Asian countries have every interest to diversify their production, and I think Ethiopia, with the power and the cost of power, the labor and the cost of labor, and also the fact that it is in Africa, in terms of tax, people tend to be a bit more, understanding tariff-wise. It's a very important aspect, and I think really position the country for a very bright future. Thank you.
Thank you so much. So during the course of today, we have answered the what of reforms, the how of reforms, and I hope in this last panel we have done justice in answering the who of reforms and really creating that partnership compact, not only amongst IFC and World Bank, but all of the development partners who continue to support the government of Ethiopia in this tremendous and amazing journey. I'm sure you'll all agree with me when we say it's a fascinating time to be involved as a stakeholder in the financial sector here in Ethiopia, be it as a regulator, multilateral, you name it, bankers. And I think the energies will continue to be high, and we do look forward to fun and exciting things. And I think in a few years' time, Ethiopia will be an amazing case study. So thank you so much. You have been an attentive audience, and see you at the cocktail hour next door. Thank you.
Thank you very much, Marlon Rollins from the World Bank, for that fantastic moderation, and to our two esteemed panelists. You can't leave the stage without a photo, so stand right here. I'm also going to invite you, Your Excellency, to join this particular group of individuals for a photo. Thank you, photographers. Thank you, Mr. Alu Miaga, Regional Industry Director for Financial Institutions Group Africa, and Al-Walid Al-Atabani, Practice Manager at the World Bank. And again, Marlon Rollins, the moderator. Thank you. Okay, so we have reached the end of day one of the Ethiopia Finance Forum. I'd like to take this opportunity to thank everybody who attended, participated, spoke, patiently listened, and those in the audience who asked questions. We have another full day tomorrow, and let me just whet your appetite a little bit. We're going to be exploring areas like digital finance, housing, capital markets, women's access to finance, a subject very close to my own heart, microfinance, remittances, and there will be a fireside Q&A with none other than the bank governor at the end of the day. So we will ask all of you to arrive promptly tomorrow. We will do our best to keep to the schedule. We would like everybody to be seated by 8:30 in the morning so we can start on time. On a final note, thank you again for your attendance. Please join us just outside on the terrace. Marlon said cocktails. I'm not sure if it's cocktails, but I saw coffee and I saw tea. But maybe Marlon arranged some cocktails. I don't know. But no, excited to meet with you all out there and continue the conversation and networking and enjoy the rest of your evening. A round of applause for yourselves, and see you tomorrow.
It's my great honor, on behalf of the National Bank of Ethiopia, to welcome you all to the inaugural 2025 Ethiopia Finance Forum. It's my great honor, on behalf of the National Bank of Ethiopia, to welcome you all to the inaugural 2025 Ethiopia Finance Forum.